it's hard to see where this recession is going to come from.
We're going to be in this 3 to 5% inflation environment for the next 3 to 5 years.
I do think that there's probably a little bit more disinflation in the pipeline.
I think it's appropriate for the Fed to take a pause here and see.
I'm so convinced that inflation is going to get down to 2% on its own, with or without any help from the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly negative on the S&P 500. I think for the second or third time this week, waking up and looking at China, to the data and some of the commentary around that economy right now. New loans extended by Chinese banks on a monthly basis. TK plunging to the lowest since 2009. There are real legitimate concerns about what is developing in the world's second largest economy.
Like any other financial instrument, you look at the income statement dynamics and the balance sheet statement dynamics. And I agree with you. I mentioned this, I believe, yesterday or the day before in our China frenzy, that the flows on the balance sheet in and out are what matter. And this is FDI from us to them, off a cliff, from them to us. Maybe not a cliff, but it's down.
The data dropped in the last hour or so, and Lisa, the response pretty clear from many people on the south side. SocGen went in. This is going to lead to more stimulus out of the PBOC and maybe out of China more broadly. We'll see, because we haven't seen it large scale just yet.
What kind of stimulus at a time where they're very concerned about the debt load at a lot of the local governments? I mean, this to me is the conundrum for China right now. If they want to move away from leverage, if they want to create a more sustainable economy, how do they then stimulate an economy where you look at some of these local government debt piles that one Goldman Sachs estimate has at $13 trillion outstanding?
And this is really important. I mentioned this recently, and I got some heat for it. Some people emailed me in and said, I don't know what I'm talking about. Federalism in China is different than here. It's not like a federal government, the capital. It has always devolved to the cities. The critics will say it borders on an organized structure, whatever. And Shanghai gets a focal point, but my knowledge base is that there's got to be more than just Shanghai involved. These cities are troubled.
Should we get to the president's comments at a fundraiser yesterday evening with this to say that China's economy is a, quote, ticking time bomb, and referring to leaders in the Communist Party, Tom, as, quote, bad folks. Bad folks. I thought at a time the administration was trying to shore up ties with the Chinese government. That's not going to help out that cause at all, if that is the objective.
On the next break, if we're not talking about Harry Keene, I will put out an article in the Foreign Affairs magazine from 8 months ago that goes to what the president's alluding to. We need to be delicate on air. There's things we can and cannot say, but there is this gauze of how did Mr. Xi become Mr. Xi? How did the leadership in China become who they are? And the president alludes to that in terms of organized political
Are you
systems.
censored? Is that what you're saying?
I'm censoring myself. I've
Okay.
got John Micklethwaite's in my ear right now. Tom, shut up.
Well, you're censoring yourself, but Joe Biden didn't censor himself.
No,
and this is really the question that I
Yeah,
have. Well, does he not have to, really? Does this really fly with the economic policy that they're trying to do? I mean, you're trying to toe this line between saying we're going to try to repair relationships and create some sort of communication to avoid some error, and then bad folks, ticking time bomb. I mean, it's not going to exactly go over particularly well.
Can I share this line with you that the president also shared with potential donors yesterday? China's in a position where the number of people who are of retirement age is larger than the number of people of working age. Now, if you're in the business of correcting politicians, you'll be very, very busy. But on that particular line, we've even had to write in the story this morning a statement that was not only incorrect, but also off by hundreds of millions of people. TK, you do wonder, when the politicians start talking about the economy, where do they get some of these lines from that just don't stack
they're playing to their
up?
audience.
You can't reconcile
John,
with reality.
This is absolutely the heart of the matter, is they're playing to the domestic audience in the United States of America. And the China people we talk to, I think a China Beige Book is just one example. They're looking at far more than just 3 cities on the Pacific Rim and what we think. I had an offspring once, and I said, where are we going? And he mentioned some city I couldn't pronounce.
Losing count of children.
Well, this is cash flow.
Yeah, exactly.
I'm talking to cash flow, and I go, where are we going? And we're going to some city I can't pronounce. And I go, well, what is it? And he says, it's one of their 14 Pittsburghs. and that's China.
Yeah.
It's one of their I'll always remember that, 14 Pittsburgh.
Let's turn to the price action this morning. Good morning to you all just tuning in. In the equity market on the S&P 500, negative here by 0.1%. Actually heading for a second week of losses on the S&P, which, believe it or not, is the longest weekly losing streak going back to May. In the bond market, yields are lower by a couple of basis points on a 10-year 4.09%. I think we could call it that. Yesterday, yields up and away, Bramo. Even after that CPI print, it was about San Francisco Fed President Mary Daly pushing back a touch, and also that issue at the longer end, the 30-year auction, just a bit softer compared to the 10-year and the 3-year before it.
Selling at the highest yield going back to 2011, raising questions about the longer-term fiscal prospects. The latest read on inflation today, 30 a.m., we get U.S. PPI. This is the input prices for a lot of companies. It has fallen off a cliff, going to zero, basically, until now. And it's actually expected to stabilize and tick upward, particularly with the increase in oil prices and commodity prices, which I think is a major theme. Mohammed Al-Arian was great on this yesterday. 10 a.m., University of Michigan sentiment survey related to this. How much does it roll over as a result of higher oil prices? And at 12 noon, this is sort of on the peripheries, but it's not. World agricultural supply and demand estimates come out for corn, soybeans, cotton, and wheat. An hour later, we get rig counts from the Baker Hughes rig count data. And I want to understand whether we're reaching an inflection point upward with food costs, particularly with wheat. We've heard about some of the supply concerns there. We've heard about rice. How much does that become a persistent story in the backdrop, kind of fueling a little bit more inflation of the very bad kind?
Lisa, thank you. Dan Morris joins us now, I'm pleased to say, out of London, Chief Market Strategist at BNP Paribas Asset Management. Dan, is it too early for this Fed to declare victory?
Oh, my. Yes, definitely. We don't see really any possibility for the Fed to be cutting rates until next year, and that's even under, I think, a fairly benign scenario for the outlook for inflation. They're really going to want to see a trend in the headline figure. You know, it is moving in that direction, but we got a long ways to go before we get to 2%.
Daniel, BNP Paribas, I think, is a view, a global view, a U.S. view that people are very comfortable with right now. We're really not believing the good news of disinflation. What do we have wrong in our interpretation that disinflation is in place?
Well, I think what's notable with the CPI data that we got yesterday, which really was about as good as you could hope for. I mean, it was around expectations, but if you look at the core figure, I mean, we've had monthly core inflation under 2% for 3 months in a row. So that's really encouraging. Now, of course, there's a question about what's happening with shelter prices, but the market should have, we think, reacted more positively. And I think it's notable that, particularly, say, with tech stocks, with NASDAQ, you didn't really see any bounce. And really, what's driving tech stocks has been the expectations for policy rates and inflation. So I think for us right now, it's more a lot of good news has been priced in. Growth is still going to slow whether or not we get to a recession. And I think that's what we need to price into U.S. equities.
Where to invest now? Take the econo-babble of a Friday in August and give it over to an investable belief for Q1 of next year. Where do you place marginal assets now?
We're probably most optimistic on the outlook for U.S. rates, both nominal and tips. If you look at the level, well, really the level we were at a week or so ago, or in the last few days when we got above 4%, over 2% on real yields, we thought that was quite attractive, increased our overweights to those sectors. It's already started to come down, but we think there's more potential there. Again, we've got to price in either lower inflation or lower growth. And you're at levels that are historically pretty high, both for nominals and reals. And we think the outlook there is probably, on a risk-reward basis, the most attractive.
Dan, I wonder what your take is on the price action that we've seen over the past couple of weeks. John was mentioning that we could be poised for the first back-to-back losses on the S&P. Going back to May, you can see the biggest potential back-to-back losses on the NASDAQ of the year. Is this a reset moment, or is this basically the one drawback that people are going to get, that everyone's going to swoop in and buy?
I think that'd probably be a bit too optimistic. I think a lot of it is how the market, or really where expectations were at the beginning of the year, when it was just all this talk about the recession and the slowdown, the last place you wanted to be with equities. And that's clearly turned out not to be the case. But now that the market swung to being much more optimistic about the outlook, buying into a soft landing narrative, when you've already had 40-some% gains in the NASDAQ, it's hard to see that continuing from here. So we're expecting subpar performance for U.S. equities, for tech stocks, and are looking still for potential out of EM Asia and still out of China.
So are you selling aggressively on the margins when you take a look at where the gains are to lock it in anticipation of what you expect to be a tumultuous end of the year?
We've already gone underweight on the U.S. I don't think the expectation is necessarily to increase the underweight. I think we're pretty happy with that right now, and just really looking for the overweight that we have in EMH and in China to materialize. And given the data that we've had recently that you guys were discussing, it may not come immediately, but we're still optimistic that it will materialize between now and the end of the year.
Dan, I wanted to turn to one feature of the conversation that's dominated this week. It's pricing power in America and labor power as well. Dan, where do you see that pricing power sector to sector in the United States right now? Who's going to be able to get margins not only to hold up, but maybe even expand in the next year or so?
Well, certainly that margin expansion you can see in the expectations for earnings growth or consensus estimates for earnings growth. And we're probably not quite so confident that that's going to come through. So we think the risk is that actually that doesn't happen, that you don't see many sectors able to push, again, those price increases onto consumers. You do then see the contraction of margins and those earnings estimates start to come down. So I think it's the opposite scenario is what we think is more likely to happen.
Dan Morris, thank you, sir. Good to catch up out of BNP. I bring that up after the moves we saw yesterday. GM coming off the back of its worst day of the year so far. The stock hammered this morning, for those of you interested, just about positive in the pre-market. But one to watch, the unions have got some big asks. So let's go through a few of them. They want a 46% wage increase, the restoration of traditional pensions, cost of living increases, a shorter working week, and better retiree benefits. And as one analyst said, Tom, these names right now in the penalty box until this is resolved.
That famous Bloomberg Surveillance phrase, there's absolutely no alternative. We heard that at the Renaissance Center in Detroit. We were there for the upset of the auto industry. Steve Ratner, as car czar, was there on that given day as well. And there was a labor shift there, John, from my childhood in 170,000 Teamsters, blah, 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 down to something that was lower wage. The unions want a jump condition back to what they remember from their fathers and mothers. It's as simple as that.
And these brands now need to compete with Tesla. What did Tesla do yesterday? Tesla was up as they were getting hammered. And Lisa, I think we're all familiar with the why.
Yeah, and this has been the story, is that basically they have been cutting back, expanding, and they have been not tied to the unions. They have actually pushed back more aggressively. And Elon Musk has come under a lot of fire for that, including from the president of the United States. And yet here we have General Motors and Ford talking about $80 billion of costs for each of them if the UAW comes through with some of these asks. And we heard this yesterday from people who came on this show. Victoria Fernandez, she came on. She was like, listen, I'm not going to go for a company that could potentially come under pressure from the unions.
How do these brands, how do these companies, Tom, compete?
Well, they compete, but also it's almost like Disney, where there's a strategic cause as well, which is, does EV work? I mean, over the weekend, into your weekend reading, folks, I'm seeing in the zeitgeist the idea that EV is 7% of the auto public. I mean, that's a small number. And Ford and GM and the rest of them, including the European makers, have to figure out, how do you do the labor construct to make profit which shareholders demand, given a seismic technological shift that's a complete mystery?
And how do you get the workers on board, because they are not particularly happy with a lot of the electric vehicle
Why should they
policies?
be on board? Their real income is cratered.
Well, so here's the issue, right? Have we really reached a point where labor still has power because of just a declining working age population? And does that cause a real shrinking in margins that we haven't really seen yet, that people aren't really going to account for? Is this a name-by-name story, or is this something broader?
You didn't live it. I didn't live it. Peripheral Rochester Delco. John, you lived it. The Midlands of England was Auto Nation.
Yeah, not anymore.
And it disappeared.
Coventry was the heart of it, yeah.
Why did it disappear?
Coventry was the Detroit of the United Kingdom.
Why did it disappear?
You can blame a lot of things. I think most people would point to globalization, which has decimated both Detroit and the likes of Coventry, Tom, and the Midlands. I think we can blame them too.
Okay.
I think we can also talk about EVs not being green. Do you see the new Cadillac Escalade? Give me a break. Electric, green, good for the environment.
Yeah, the size of a building.
Shut up. From New York, this is Bloomberg.
We are at a watershed moment in our economy. And I'm not just talking about the fight against inflation. in which we are making progress.
Inflation will gradually make its way down, but it is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target.
The Federal Reserve has a dual mandate from Congress. The first is to foster stable prices. And this is why we have been working hard in recent months to reduce inflation, which has been too high, and bring it back down to our target of 2%.
Fed presidents there, Harker, Daly, Bostic, they all agree on one thing. There's more work to do. Now, whether you believe that means more interest rate increases or just holding them here for a longer period of time, I guess it's up to you, and we'll see various Fed officials take different views on that. In the equity market on the S&P 500, this rally really faded going into the close. Off the back of the inflation data, equities up. Then it started to fade as Mary Daly started to speak, and in the afternoon, we had a pretty soft issue on the 30-year maturity out of the Treasury. So 3-year went well, 10-year went okay, 30-year, in comparison, not so good. Yields up this morning, down just a touch on a 10-year, 4.0977% on a 10-year this morning. The euro really not giving me much this morning. The euro at the moment, Tom, 109.87. But if I'm in Europe, I'm looking at China. And the data out of China this morning, once again, not painting a picture of an economy that's rip-roaring and on fire right now.
There's a lot to talk about in the Asian Pacific Rim, and I'm going to go here at some point, John, to Euro-Yen and that. But to have Steve Englander on with us to frame our FX market into the weekend is important. Global head of G10 FX Research at Standard Chartered, with all sorts of wonderful Yale economics on the American economy and on the disinflation witnessed yesterday.
Steve, wonderful to catch up with you, sir. Question of the week in foreign exchange, asked by Kit Jukes of SocGen. Why is the euro not weaker given what's happening in China? Why isn't it?
I think that, the market wants to sell dollars most of the time, and it's being forced to buy dollars kind of against its will. The market is pretty long dollars. I think most investors think that the inflation is sort of disinflation is in the bag. And I think that they're waiting for the economic data to slow down so that the Fed hikes go out of the picture and the prospect of cuts come in. I would add one more thing. I mean, and this is, I think, this doesn't happen all the time, but this is like a unique situation or a relatively rare situation. Right now, the U.S. is a high yielder, and market sentiment is very risk off. So you're a safe haven and a high yielder. That's a very powerful combination in the short term. And so we have to see some action on the yield side for the selling that the market wants to do to resume.
Stephen, in your research note, you go to 6-month annualized. I thought Jason Furman at Harvard led yesterday with an interesting idea of where to look for the rate of change of disinflation that's out there. I think the key question for our listeners and viewers is when we move, does it take forever to shift to a disinflationary central bank, or will it be, to use the economic phrase, suddenly?
Suddenly, in the Hemingway sense of the word, first slowly and then very quickly. Look, I think that the Fed isn't going to give any quarter until it becomes clear that the U.S. economy is slowing. They really feel comfortable riding the Phillips curve. And if they see some sign that the labor market is weakening, along with the disinflation that's obvious out there, then rate cuts will very quickly come into the picture, not slashing them down to zero, but sort of 25 here, 25 there. I think right now they don't see the upside, as Mary Daly said, in declaring victory. Even if they're right, that's not going to help them. And if they're wrong, it would be catastrophic.
Last week, everyone was talking about political risk, fiscal risk, that suddenly that would matter again for currency traders. Has it?
Well, yes, but in the wrong direction, I think, because look, I think Fitch was right to downgrade the U.S. It's very different than 2011. 2011, we came out of the debt crisis with a very strong fiscal deal that limited spending. This deal, the one that we got in May, enshrined sort of most of the spending that we had during the COVID period. Is just not going to go away. So I think that the combination of the absence of a mechanism to arrive at a fiscal outcome, plus the settings that are kind of looking in the wrong direction, the U.S. isn't going to go bankrupt, it's always going to pay its coupons, but whether it pays it with a weaker dollar or higher inflation is the question.
So some people are attributing the recent rise in yields to this idea of political risk, of fiscal uncertainty or fiscal, at least largesse when it comes to the debt. Other people say it's just a story about the Bank of Japan. It's just a story about money flows, not necessarily coming in the same way from that economy based on yield curve control, maybe being tweaked, maybe being abandoned. Do you agree with that?
Well, I agree with the first and not with the second. There's nothing meaningful that the Bank of Japan has done in terms of limiting the flows that they're putting into the market. Basically all they've done is let the yield go up a little bit to market rates. I think, if you look at the way the long end has been trading, given that there's no real shift in expectations of what the Fed is doing, this is all risk premium, and it's risk premium concentrated way out the curve, which tells you that it's not a, specific, immediate, next week retail sales, that's going to be the problem. It's something that says, look, we're worried about the distant future, and now we're, pricing it in. And that's fiscal, I think.
Steve, I want to shift here, segue, if I can, over to what traders are looking at this weekend, which is take out the dollar. Euro yen is extraordinary, 158. We had a 159 print as I walked in the door this morning. What are the ramifications for Japan, for the Pacific Rim, if we see Euro yen break out to a 160, a weaker yen? We're right at the precipice on the weekend. What's the so what here?
Well, I think that the yen spills over in competitive currencies. So it will have an impact on Korean won. It will have an impact on China, a few other currencies. I think, honestly, there's a bit of puzzlement as to what good a weaker yen is doing Japan. But I think it just sets the tone. The market would really like to sell dollars against Asian currencies. And we think towards the end of the year, that's what's going to happen, that the risk environment will improve. But it's very hard to do as long as the, sort of yen against the dollar and yen against the crosses are pushing up against these levels. I don't think the market's piling into short yen at this stage. They're short enough. I think it's more that they're waiting to see some sign that there's stabilization there and maybe a move back. And that would, and plus an improvement in the risk environment, then the dollar selling would resume. But, I don't think it's going to happen over this weekend. I think it will take a little bit of time.
Steve, before you go, just to double confirm, triple confirm, you think the Fed's done here?
Oh, yeah. And I think there's a risk they cut faster than the market thinks. Once the data starts sliding, you kind of say, what's the point? If, labor market is weak and inflation's coming down, you've kind of won. You don't cut, you don't cut very far, but you might throw in the token cut, Q1 and to show that your heart's in the right place.
A token cut in Q1 to show your heart is in the right place. Steve, what a change from 12 months ago.
Yeah, but, they've really come off their hawkish tone. I mean, nobody's talking about that second hike in the dots. They just brush it aside if they're asked. And I think what they're doing is just trying to be sure that they're not sounding too dovish prematurely. But I think everybody reads through the comments and says, look, they're, it's a failure to commit. It's not because the data don't justify. One last thing, very quickly.
You got
take
20
a look
seconds.
at oil prices. They went up from like 65, 70. Now they're north of 80. During that process, 1 year inflation expectations came down from 2 to 1.5. So, which means implicitly that core expectations have collapsed, just like we saw yesterday in the numbers, and that's likely to continue in coming months. They're in a very good spot with respect to inflation for the next 6 to 12 months.
Steve, we'll continue this conversation. Steve Englander of Standard Chartered. To show their heart's in the right place, they're going to cut in Q1. Bramo, that's quite a statement from Steve Englander this morning.
Especially when he says, what's the point? The data starts turning lower. What's the point? The point that a lot of people feel is that longer term, there still are some inflationary pressures that have yet to truly show up.
The history here is simple. They get overwhelmed by the data coming in and they have to act fast.
What a split, though. There's a conversation right now on the other side, and Lisa alluded to it, about inflation reaccelerating.
Yeah.
We'll see.
Yeah, specific components.
Or at least sticky.
Abigail Walt of Aberdeen, coming up next from New York. Good morning. you to the weekend. Said that twice in the last hour. I'll say it more.
Nervous.
Let's get you to the weekend. Your equity market on the S&P 500, negative 0.1%. We're down on the week, down on the session, just a little bit. On the Nasdaq 100, we're down by 0.2% on the Nasdaq 100. Poised for the longest losing streak of the year on the Nasdaq, just pulling back once again. On a Russell, just slightly firmer, but pretty much mild moves this morning across the board. In the bond market, nothing mild about the moves yesterday. Wow, 30-year issue soft, bit of Fed pushback, yields up and away, curve steeper, bigger moves down the longer end, 10s and out. Your 10-year this morning comes in about a basis point, 4.0958% on a 10-year. On the 10-year, we're rising for a fourth straight week, fourth consecutive week. Yields higher. In the FX market, the dollar stronger also for a fourth consecutive week. This morning, just a touch weaker against the euro, 109.93. At least no real change here, just between 109 and 110 through the last couple of weeks.
It's the push-pull of European economy facing off with China and what the weakness there has to do. And it's the U.S. possibly at the end of a rate hiking cycle. And these dynamics are just in this push-pull sort of holding pattern that can't seem to break out.
Under surveillance this morning, let's get to it. President Joe Biden blasting China's economic problems as a, quote, ticking time bomb, and referring to Communist Party leaders as bad folks at a political fundraiser. The comments come as the administration is seeking to improve overall ties with Beijing. And Lisa, comes before some data that spells out a pretty dire picture of the economy in China. The new loans data that you get for Chinese bank offering loans to the economy, the worst we've seen it going back to 2009.
They have a problem, and this has raised questions about whether this gives the U.S. more leverage. But is the U.S. trying to have a better relationship with China? And if so, what was President Biden thinking, saying that it's a ticking time bomb and that they're bad folks? Because at this point,
for the U.S. audience.
Is he, though? I mean, honestly, at a certain point, the bang for the buck here, what are you going to go for? If he actually has affected some sort of restraint with investment, if he actually has, some people would argue that it hasn't been very strong. Other people say it actually is significant. You've got both sides of this. Why can't you just point to that? We're doing this.
John, The Economist publishing literally in the last 12 hours has a brilliant short essay on basically on the supply chain, the manufacturing process. It used to be China to America, and now it's China to Vietnam to America, or China to Mexico to America. So there's a huge debate about the accuracy of these kind of statements.
Two things. One, policy. Two, rhetoric. On policy, the policy coming out of China, or rather coming out of the United States for China, much narrower than people thought it was going to be 12 months ago. And it's narrowed down and narrowed down and narrowed down. Watch the policy. On the rhetoric, it's for the donors. What's interesting here is this is how you raise money now in the Democratic Party. This is the position you have to have.
I agree with that.
It's the position that Republicans have to have as well. So you're going to hear lots of this going into the presidential campaign next year. Just keep an eye on the actual policy. Is it going to be as hard as the words you hear, Lisa, coming out of the administration?
A lot of people yesterday said no, particularly with the narrowness of some of these investments. Other people, particularly on the Democratic side, saying, actually, you know what, when you look at it, it's pretty significant. So, you know, you got both.
Quickly, under surveillance, we want you to read it in the weekend and be smarter into the fall. This is my essay of the year last year. This is on China. It is on Beijing. It's in Foreign Affairs magazine, John, without question, the most courageous essay of the year. This is Kaiji. I'm sure I'm mispronouncing her name. She was thrown out of the Communist Party. And this is a brutal essay which directly goes to the city's relationship with Beijing, the weakness of Xi Jinping. I can't say enough about this essay.
Have you put that on X, the platform formerly known as
Twitter? I put it out
Twitter?
on X.
Okay,
I put it out on X. But this is a superb essay.
Zeeting.
Yeah, he's like,
not
I
posting.
Zeeting.
You're posting and you're reposting.
Let me update you on this story, a serious one developing over the last couple of days. Hawaii Governor Josh Green saying Lahaina wildfires are the largest natural disaster his state has ever faced. 55 people are confirmed dead. 1,000 remain unaccounted for in the small seaside town that has largely been reduced to ash and rubble. The blaze is 80% contained, according to firefighters. Now, Tom, that is the only piece of good news here, that this one is just about contained, because the pictures are pretty shocking.
I'm going to let the experts tell us here, but it's got to be about the new, drier world. You see it in the Mediterranean. You see it in Spain. We met with a Spanish finance minister. Why is this any different? It's a new, drier world. It's a different Maui.
The implications, though, I mean, this was a vacation center, right? And there are estimates out there right now that this is going to take $8 to $10 billion of both damages and economic consequences to one of the main hubs of vacationers. And this really raises a longer-term question about Hawaii, but also on a larger scale, other places that are devastated by some of these wildfires.
Massive rebuild effort needs to be had there once they get that contained. Final story for you. Harry Kane is set to say goodbye to Tottenham after nearly 2 decades. Set to leave for Germany later on today to join Bayern Munich, a 4-year deal reportedly worth, Tom, $110 million.
You tell me, John, you're expert on this. How does this team go on? I mean, I don't even know what the American equivalent to this would be. This is a way bigger deal than Aaron Rodgers leaving the Green Bay Packers.
Forget Harry Kane. Forget all the players involved in this, with the exception of one man, Daniel Levy. To do this going into opening weekend for the Premier League on the eve is absolutely shocking. To see that happen, to lose your best player with no time, very little time left in the transfer window ahead of a new season, to replace him and think about rebuilding the team. Because this isn't a man who just scores goals, Tom. He's a guy who drops back, and you've seen there, you've been to White Hart Lane and witnessed the game. Drops back. There's a lot of work in the build-up play.
Yeah.
As they make attacks.
Well, my amateur take here is this guy's what you call a striker, which is the guy up front scoring the goals. But the magic that I saw that you don't see on TV was how he would help the middle of the field begin to create the plays forward.
So, Tom, let's think Pete Brady, Patriots, right?
Tom Brady.
Except Patriots won things and Tottenham don't. But let's put that to one side. Imagine this happening right before the start of a new season and not knowing who your quarterback is. That's ridiculous.
I think what's important here, Lisa, is we need team coverage here. We're going to be in London here in the next coming weeks, and I just do think a remote is in order.
A remote to London or a remote to
Arsenal
Germany?
Or to us, I'll let John's
Did you see the club he led with, though? He said Arsenal.
Really? You're going directly to their competitors? Seriously? By the way, we don't even know if Harry Kane's going to go over to Bayern or whatever.
He's a medical.
Yeah, well, I mean, it's sort of like maybe they're still in negotiations.
There was some odd story that he was on his way to the airport, and then he had to turn around because he hadn't been given clearance. I saw some of the reports coming out of the UK, just absolutely bizarre. It looks like, based on reports, this is like this close to happening. So we'll see. Watch this space.
We're going to move forward here with the advent of Premier League football, and truly a joy to have John Ferro driving our coverage on Premier League and on F1. Is the F1, they're often like till September 1 or something, right?
Yeah.
We're going to wait on Monza and all that. John Ferro from Monza.
Monza in early September.
You see it right now.
Is one to watch.
Of course, what you want to understand is that Man City plays Burnley this weekend. In the last 8 matches, thank you, BBC, for informing me. Here's a partial score. Man City 26, Burnley 1. So we had to go out and get a token Man City fan to start off the season. And John, for you to bring in Abigail Watt at Aberdeen, I just think is brilliant, because she more than anyone we know, she bleeds the light blue of Man City.
We've got to be really careful here, Tom. There is a difference between a Main Road Manchester City fan and an Etihad Manchester City fan. A Main Road Manchester City fan is a fan of the club when they didn't have money. That was the old stadium. They'd watch them get relegated, come back up. Right. Really difficult. An Etihad Manchester City fan is the kind of fan that supports the team that's winning because they've got a ton of money and they're all the best players. Abigail Watt is a Main Road Man City fan, research economist at Aberdeen. Abigail, wonderful to catch up with you. I actually wanted to start in the UK, if that's okay. The data out of GDP, pretty decent relative to expectations. We were over at the IMF World Bank meetings back in spring. They were talking down the UK hard. Can you tell us how well that economy is performing at the moment, just in the aggregate numbers, and then we can turn to what's happening beneath the surface?
Yeah, so as you'll have seen this morning, the UK growth numbers came out a little bit stronger than expected. We saw a 0.2 Q-on-Q increase in activity in the second quarter. If you dig into the detail of that, one of the key things that we saw was a return to work after the kind of holiday that we'd seen in May. So the industrial production side was pretty strong in the June growth data. That said, services were also a little stronger than expected. So, you are continuing to see, I guess, consumers being, I guess, more resilient than perhaps even we'd expected in the UK.
Abigail, there's just a lot of talk about this here. And a great fear, I think, over time is the concentration of prosperity in London versus the rest of the United Kingdom. As you look at finance and investment for Aberdeen, is that an advantage or a hindrance, not only in the United Kingdom, but in other countries?
Yeah, I mean, I think you have to think carefully about your investor base. I think it does help, I guess, having that concentration in certain areas is useful for us as a firm. I guess operationally and kind of finding our clients, but I think economically the kind of prosperity of the whole country matters and is important for the, I guess, longevity and the sustainability of growth in a number of economies. So I guess it depends whether you're thinking from a macro perspective or a micro perspective on that issue.
Just broadly, people are talking about this soft landing on a global basis, albeit much more in the U.S. than in the UK, although growth coming in stronger, even amid some of the inflation. When you take a look at the forward drivers of inflation, and I think increasingly about oil as demand reaches new record highs, food as the prices keep ticking up, are you in the camp that we could see a reacceleration that people are shrugging off and really not counting on?
Yeah, I think we're looking really closely in the US in particular. We've been very focused on kind of core services inflation and core services ex shelter. This is where the Fed have been kind of focusing their attention to. And that was one of the things that I kind of noted from yesterday's inflation data. Although the aggregate kind of top line numbers came out in line with expectations, one of the things that we saw was some of the core services, in particular recreation services and education services, coming out kind of much stronger than they had in June in terms of the month-on-month prints. And so there's definitely pockets within that kind of services sector which we're concerned about. I think the other element you've kind of mentioned there is around kind of the headline pressures, thinking about energy prices and food prices. On the kind of energy price side, we've seen this kind of summer boom almost in kind of commodities, in kind of oil prices, and that's likely related to kind of increased travel. We're kind of, I guess, we're less of the view that can be kind of maintained. I guess where our expectation is that the economy will begin to slow and therefore you'll see demand kind of slipping off again. The other thing that I think we've seen this week, which is interesting, is more news around kind of natural gas prices. Natural gas reserves have been kind of built up in the European area in particular, given some of the kind of effects of the Russian invasion of Ukraine last year. But we did see kind of news of strikes in Australia. And the kind of pass and feed through effect of that through kind of natural gas markets. And you saw that happen quite quickly this week. We've since seen, I guess, some of those fears abating. But it does show that, there are risks there to the upside still on inflation.
Abigail, with all of that in mind, let's finish on this. Where do you have more confidence that we've seen peak rates? The Fed, the Bank of England, the ECB? Where?
I think the Fed, likely. I think the inflation dynamics have maybe shifted slightly in the US relative to what we're seeing in the Euro area and the UK. In particular, I think in the wage dynamic, we've seen a little bit more progress on kind of softening wage pressures in the US relative to the UK and the Euro area. So I would say, I think if I was trying to say where I think peak rates are likely to have happened, I would say that the Fed is most likely of those central banks.
Abigail, thank you. Come back soon. Abigail Watt of Aberdeen, thank you very much. Thank you. It's good to see you. It's TK. Peak rates of the Fed potentially. The Bank of England, the ECB, seems to be the takeaway at the moment. They've got more work to do.
And the new overlay of this week and to contemplate into Q3 and Q4 is the idea of deflation. And there's some really interesting dynamics here. Somebody yesterday had the keyword residual there. And, I worry about the deflation overlay and all of our certitude about where we're heading.
I am not worried, for the record, about airplane ticket deflation. I am okay with that.
I'm fully embracing
fully embracing airplane ticket deflation.
One of those things in the CPI report where they tell you something's happening and I'm sitting there thinking,
don't believe it.
Is it really happening?
100%.
Is it really happening?
That was what everyone was thinking.
Vishy Turupatura of Morgan Stanley coming up.
The
saw the rebound in home values after they came down, and that could create a rebound effect along with higher energy prices and some more supply chain problems, which is why the Fed is hesitant to declare victory. I think they're done on rate hikes, but I think the higher for longer narrative is now what they're going to be leaning into very hard.
She is just one of the best. It's Diane Swonk, chief economist over at KPMG. The conversation at the moment is pretty divided. I would say the consensus believes this might be the end for the Federal Reserve. Then there's a debate about when they start cutting, potentially early next year. There are also people out there who just believe inflation has the real risk here, the potential of reaccelerating. I would say Neil Dutta of RenMac is one of those who is questioning whether the Fed has done enough. The group over at Citi, Veronica Clark, Andrew Hollenhorst, two of those as well, raising the same question. Let's turn to the price section for you. On the S&P 500, futures slightly negative here. Lisa gave you the day ahead. PPI coming out a little bit later at 8:30 Eastern Time, following CPI earlier on yesterday. Through the week, the attention very much on what's developing over in China, or rather on what's not developing, Tom. And what we haven't seen is the large-scale stimulus that maybe people were hoping for. Just hasn't happened yet. And the new loan data out of China, really, really weak. SocGen first out the gate of the notes that I saw on the south side, saying this just adds to the chances of easing out of the central bank.
And the first effort of Beijing is the allocation of debt, the visibility of debt, whether it's within the companies, the state-owned enterprises, or it's within the cities and that. And it's frankly, it's a Greek to me, John. I can barely keep up with. What really this amounts to is domestic demand and the price change around that. If you have a slower China, the prices just slog down.
When,
that's the fear.
And does this become a problem for US markets? When do we wake up and have one of those mornings where you just see treasuries bid really hard,
right,
equities down, commodities struggling because there's a real concern about that economy? Lisa, we haven't seen that. Evergrande, do you remember when Evergrande got into trouble? There was concern, and then it happened, and nothing really happened in financial markets stateside. Are we having that same approach to another developer in China?
Country Garden Holdings, which was bigger than Evergrande.
Is it bigger? I didn't know that.
Yes, it is trading as a penny stock now on the Hong Kong exchange. It's been downgraded to CCC. People are saying it's going to default. It hasn't made its payment on its interest, but it has a 30-day grace period that it's still in.
That's what I don't understand.
Against its bondholders and paying back its, particularly the interest payments, the coupon payments to the people who hold their debt. But this raises a question. No one cares in the U.S. Why is that, given the fact that this is an even bigger developer? Have people written it off? And have we really divorced the U.S. economy that much from China?
It's really what I'm getting at, Lisa, and I think we're on the same page. There is a comfort, to some degree, with what's developing up over there. Not my view, based on what I'm seeing in the price section every single morning when you see these developments turn in, I would say, less positive directions week after week.
Well, I'm looking for China to open up, and they obviously opened up after COVID. I got a huge response yesterday to $39,000, two people business class to Shanghai. That worked out. And people said, you're nuts. And then somebody came back and said, oh, actually, you're right.
Do you know how many people said the same thing to me?
Yeah.
Tons. After you said it, they went and checked.
I know. I checked too. I didn't believe you. And then you were right, and I was kind of shocked. Not that you were right, but just that,
No, it's all right. That's on the record, Lisa.
We're living in real time. Let's put it that way. What we're going to do is migrate to the airline business. And what's so important here is we all have, John has his flights. He looks at Italian islands. I can't pronounce. Lisa has a host of flights where she has to sit in Atlanta at Hartsfield for 6 hours delayed. Hey. And I have two flights. I have a flight to Paris I look at just as a benchmark to Europe. And I just look, Lisa, conventionally at New York to LAX. And I look at Google, and they got the little red and the green and the yellow stripy thing about where's the value. In 1,700 business class right now, or 2,000 is what Google calculates, is actually pretty attractive. We're getting over to the green side. That's almost a legit price, a lower price of New York to LAX.
Legit price. And this means deflation, which is what we saw in yesterday's CPI print. And everybody said, no way, we're not buying it because it's not what we're seeing. George Ferguson covers the airline industry for Bloomberg Intelligence. George, how long can true deflation last in airplane tickets?
I mean, it's going to hurt profitability for sure. I think if the airlines could change it, they would, right? Because I think it's part of the competitive dynamic. Everybody's returned capacity to the marketplace. And I feel like it's the consumer starting to, run out of gas. I think we've said that for a while, though, so maybe they're not starting to run out of gas. They are running out of gas. Some of them are. Which is taking demand down, and business hasn't really returned, right? Not in full force. We're seeing it 65 to 75% of what it was pre-pandemic, and I think that's the dynamic here behind airfares coming down. I think it continues.
I want to push back a little bit because if you look at the CPI, it really is based on domestic fares. When you take a look at where people are going, it is international. That has been what's fueling the profitability. And those prices, if Tom Keene's gauge of flights to Shanghai or any indication, are not going down. So at what point are we seeing a distorted metric about deflation that's really focused on domestic markets that haven't yet picked back up, even as average prices continue to increase pretty dramatically?
Yeah, so I'm not going to disagree with you. We spent a bunch of time yesterday on correlations with CPI and airline fares, airline yields, and totally agree that domestic is a lot more correlated than the international markets. But what I will say is there is a small correlation. We are finding correlations higher after the pandemic, which is a long way of saying there's more consumer in that number right now. And so that consumer CPI is mirroring airline yields more. But I guess if I drop back and I just think logically about this, there's a lot of demand for international this year, especially Europe. China is its own issue. There's not all the capacity back in that marketplace yet. So those aren't real fares yet. There's real limitation there. But if we drop back and we think about it logically, look, we see a big snapback in Europe like we did domestically, Latin America, as we came out of the pandemic. Europe's been open about a year or so. We don't think this can persist into next year because we think the bounce back is this year. And in Europe, yes, you'd plan earlier. So I think there's probably a lot less tickets to sell. And that probably hangs in there for most of the year.
George Ferguson, you're expert on the actual planes and the engines and all that. I saw a wonderful Big Jet TV YouTube video yesterday of an Air Canada 747, which had been repurposed as a cargo jet. Is a lot of that going on, the efficiency of the George Ferguson world? Is everybody repurposing airplanes for the new Ferguson aviation era?
So I don't know if it's the Ferguson aviation era, but I like it. I would say that a lot of airplanes were repurposed into cargo during the pandemic because cargo was so hot. Air freight rates have come off very dramatically since then. I think you're going to see a lot less of that. Lufthansa, big operator in the logistics world, earnings, their 2Q earnings in logistics down 90+%.
Wow.
Yields have really, air freight rates have really come down. Again, they're getting back to normal. They're getting back to pre-pandemic levels, but that pandemic surge in air freight over, less of that going to happen, Tom.
Do you pay for a subscription, TK?
I pay. He's so good.
Do you pay for this?
Yes. The guy that does Big Jet TV, he'll give a shout out to Ferguson. Ferguson's so large. But the guy that does it is the son of a pilot. And his enthusiasm about it is what we knew as kids.
How much is a sub?
777.
How much is a sub? How much is a sub?
I don't know. Vetbill pays. Vetbill's in charge of that. But it's great. The guy's flying around the world. DFW, Anchorage. He was in Anchorage a couple weeks ago doing a cargo thing.
Okay.
He goes all around the world.
I thought he was British.
He's British. Yeah, he's British. But his famous thing, he's at 27R at Heathrow, and he watches the planes take off, and they come in, and they'll be way off in the distance, and I can't tell what it is, and he'll go, 777.
Okay, can I ask you a real question? Did you even know about Big Jet TV until that one day that we were on air?
No clue.
Of course you did.
Of course you did. Right, so just saying that.
I'm pretty sure I introduced you to Big Jet TV.
I think you did probably.
Yeah. George, thank you. George Ferguson of Bloomberg
Ferguson
Intelligence.
Didn't expect this.
This show's off the rails this week.
It's good. It's summer.
Is that what this is?
We'll become more responsible
summer
in September just for you.
After Labor Day weekend, we'll become more responsible.
Some of us don't go on 4-week vacations, John, where we have to go off the rails.
TK, I'm running a tally. You've taken more time off this year than I have.
I'm staying out of this one because I probably would win this one.
You're becoming more Euro.
I am very sensitive.
More Euro by the day.
Yes.
You like that, though? You think we've got it right over in Europe? I feel like you're coming to that side.
I have always been, and it's from my parents, embarrassed by the American work ethic, which we are as guilty of as anyone, of work. You go on vacation and you work while you're on vacation. I literally studied for the CFA exams on vacation.
I'm
Literally.
jaded. I grew up with academics. The summers for free form.
Like 3 months off.
Yeah, pretty much traveling.
Academic stuff.
Usually, you guys, John, you guys,
not kidding.
Maria Tadeo,
Totally wrong.
What a treat.
Maria
100%.
Tadeo does it so much better than we do.
Where is Maria?
She's on vacation.
Exactly. Of course she is. Emily Rowland of John Hancock Investment Management coming up next.
It's hard to see where this recession is going to come from.
We're going to be in this 3 to 5% inflation environment for the next 3 to 5 years.
I do think that there's probably a little bit more disinflation in the pipeline.
I think it's appropriate for the Fed to take a pause here and see.
I'm so convinced that inflation is going to get down to 2% on its own, with or without any help from the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience
Third.
worldwide. Is that 3?
Yes, that was the third.
This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Plenty of feedback in the last 5 minutes when I said this show was off the rails this week. This lit up. Only this week. Only this week. Only this week. It's always off the
Come
rails.
on, I'm medicated.
I know.
Harry's going
I
to
know.
Germany. I'm medicated.
You're medicated. Is that what this is about?
Yeah.
Your equity market right now is negative 0.1% on the S&P 500. Again, we're talking about China. Some of the recent data out there, pretty difficult. It's a tough moment for that economy. The question we've all got, what can they do about it, Tom? What are they willing to do about
A
it?
lot of hand-wringing about what they're going to do, and the theme today for those overnight is a look of Beijing out to the cities, and the cities are not just the new Hong Kong and Beijing or Shanghai. It's a huge country out to Chengdu, to make a generalization of it, of devolving debt tension out to the cities, and that will be, I think, the story point over weekend reading as well. John, I would dovetail it with currency dynamics, what we see with Euro Yen and Steve Englander earlier. And also, amid this disinflation, can I note that the real yield is right back up near that 1.80% level? We haven't talked about that yet.
So
this morning.
disinflation stateside, Tom. In China, the data so far, deflation. And fueling that conversation this morning, the team here at Bloomberg leading with this line: Chinese banks extending the smallest amount of monthly loans, Lisa, since 2009. That's just going to feed those fears a little bit more.
And is this an issue of banks not willing to lend or people and companies not asking for
Nailed it.
loans? This is the real question. If you have an economy that's in stasis, that's basically atrophying in certain areas because of age differentials, because of consumers not spending, what do you do? Do you stimulate at a time where there's this debt overhang? And then the larger question, does it matter for the U.S. economy? To what degree are we not pricing that in?
Absolutely nailed there the microeconomics of it. The media focuses on banks as what's Jamie Dimon doing, what's Brian Moynihan doing, and as you correctly state, the loan demand is absolutely critical from the public. The other way I'd look at this is disinflation towards deflation mathematics is just not studied because it doesn't exist, except the British have as a third rail an understanding of this before World War II. Their depression was totally different than ours and was a true outright deflationary moment. The British and their academics just totally gets this mathematics, where Americans were like, growth, 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 growth. It's all going to get fixed. Growth, growth, growth. We'll fix this. We need more growth, like what we heard from the president overnight.
Are they pushing on a string? Let's make this really, really
that's a cliche
simple.
from the 30s.
I speak to a lot of people who know what they're talking about in China right now. There's a shock to confidence. What can they do about it? Coming out of the shutdown, we all thought China booming. That was the consensus view for 2023. China boom, US potential recession, the Fed cuts rates. Turn that story on its head for the year so far.
Yeah, well, I wondered, like, does Andrew Hollenhorst, Bill Dudley, does Mohammed El-Arian suggest that we need to worry about deflation? I think they would push back against that. They would say the system will solve that angst.
Let's turn to the price action. Got a great guest coming up who's going to talk about some of this. In the equity market, almost totally unchanged on the S&P 500. Talked lots about the bond market through the week. We had some issuance from the Treasury. I say some. I'm using that word loosely. Had a ton of issuance from the Treasury this week. 3-year went okay. 10-year was all right. 30-year was a bit of a struggle yesterday, so that fueled a move in the Treasury market. Yields up, Treasuries down. This morning, yields down by, let's call it a single basis point, Lisa, on a 10-year, 4.0958%.
Yesterday, we got the CPI report. Today, we get the Chase or the U.S. PPI report. That comes out at 8:30 a.m. Do we see the same kind of disinflation that can give everyone this warm and fuzzy feeling of a soft landing? Or do we start to see it tick up and concerns, particularly about commodity prices, starting to reverse and inflect upward? 10 a.m., we get the University of Michigan Sentiment Survey. Interesting to see how much longer-term inflation expectations track the recent increase that we've seen in oil prices. And just there is this direct inverse correlation with oil prices and sentiment. And do we see that kind of play out today? And 12 noon, I really do feel like we need to keep an eye on what's going on in the agricultural space, just considering the increase that we've seen in wheat prices and this just general inflection up in food prices. Corn, soybeans, cotton, and wheat. An hour later, we get the rig count from Baker Hughes. I don't know. I'm really interested in commodities.
We're doing rig counts all over again.
I mean, to me, the U.S. is record supply, but demand is at a record. And we've got oil poised for its 7th straight weekly gain, if the gains of today hold on. What does that do to this narrative of the disinflation of the goods space if you get that bleed through kind of effect?
We could be pushing 13 million barrels a day in oil production in the United States by the end of the year, Tom. New forecast earlier this week is quite a number.
Yeah, cardinal rule, the math is there. Try not to predict the oil market. It's a good way to lose your job. Look at Jeff Curry. He's gone at Goldman Sachs. But the answer is...
You have to correct that. He was not pushed out for getting the market.
Good morning, Jeff. Good morning, Dr. Curry, I should say.
Okay, carry on.
I'll carry on here as we hope we wish Jeff Curry the best of luck. But the bottom line here, John, is you know what? Brent crudes are $90 a barrel.
You can't start rumours like that. You know that, right?
Who said it was a rumor?
What?
TK, you're in the penalty box. Jeff Curry departing Goldman Sachs, and not because he got a crude forecast wrong, TK. Emily Rowland joins now, co-chief investment strategist at John Hancock Investment Management. Emily, don't worry, we'll keep him in line. Let's talk about China. Emily, do we want stimulus out of China right now if you have a seat at the Federal Reserve?
Well, I don't know if it's working necessarily. You look at some of this loan growth data this morning, and it's simply not showing up. I think the China stimulus narrative is one that the markets have really loved and embraced, and we're getting a bit of a reality check on that. As it relates to commodity prices, all of this news of stimulus has certainly pushed them up, pushed inflation expectations higher, and that's become a big problem for the Fed here, who certainly has not yet claimed victory on inflation. So we're watching that really closely here, but a lot of mixed messages. And by the way, speaking of mixed messages, I understand trying to get to the weekend here, as you've said all morning long. If you watch the macro and you watch the fundamentals this week, the market action didn't really make a ton of sense. Of course, we had the Treasury auction that you talked about pushing yields higher, but at the same time, the economic data were pretty disappointing. Right. You had softer inflation, you had initial claims picking up, you had dovish comments from the Fed. Meanwhile, the 10-year Treasury yield sort of right where we started, and European equities trading on another planet right now.
And Emily, within your note, you talk about whipsaw, and I think it's perfect. There's one big group whipsaw here over the last number of weeks, whatever anybody's belief. With that said, in the group whipsaw that we're in right now, how do you position out 1 year or 2 year in my depleted 201k?
Yeah, it's tough. So the macro signals right now are like a stoplight. They're going from red to green and back to red. And we look at the macro messages right now as more of a yellow. You want to maybe take your foot off the gas a little bit. You want to look both ways. You want to proceed with caution. So we're starting to see this big shift in sentiment. It's been pulled back a little bit over the last couple of weeks from fear to greed, and you're starting to see more cyclical, higher beta parts of the market outperforming. We would be mindful of taking too much risk in this environment. Again, we still want to be invested. We still like higher quality stocks. We think bonds can do more heavy lifting in a portfolio. But look, the leading economic indicators have been negative for 12 straight months. The yield curve has been inverted for 13 straight months. I mean, it's just become exhausting. But we need to stick to our premise here. We need to stick to our work that tells us that a recession is likely to unfold due to the lagged impact of Fed tightening. But it's becoming difficult to stay patient for sure.
I just want to pick up on what you said about European equities trading on another planet. What do you mean? And just the fact that they haven't sold off more aggressively in the face of China weakness?
Yeah, I think it's notable to look at the strength, particularly versus domestic equities as of late. Europe has certainly been more tied to China stimulus. You've seen that. You've seen a big momentum trade there. I think as some short covering has resulted in a lot of gains in that market. And you're seeing, some major companies in Europe disappointing on the earnings front, some solvency issues there. Markets really seem to be very much enamored with Europe. They're very much enamored with this China story, and it just doesn't match up with the macroeconomic data. Look at the Citigroup Economic Surprise Index. It's surging in the United States right now, and it's about negative 100 in Europe. And yet those markets are outperforming. To us as macro investors, we want to continue to emphasize domestic equities because of the relative economic strength here.
That said, U.S. tech underperformed this week, I should say, not this year. This year they've outperformed tremendously. But how much is that going to be a real challenge to your thesis if it continues?
Yeah, we've definitely seen a pullback there. And of course, valuations were stretched and we were expecting to potentially see, a bit of a profit taking there. And, I still wonder if tech is the biggest issue that markets should be focused on. It's hard not to like quality in this type of a market. And of course, tech is your poster child there. I think over 3-5 years, we've seen that U.S. technology sector has produced of the best earnings globally. Of course, we want to diversify from some of that. Look at some of the ways the sectors that are starting to perk up a little bit here. Healthcare, one of our favorites. It's trading at a meaningful discount to the S&P 500. It's got the quality metrics that we love, great balance sheets, good return on equity, and it's more defensive. So I do think that the baton can be passed here in the back half of the year into next year to some of these more defensive sectors in order to create that balance away from the tech sector.
Emily, final question. Are you on the strong dollar train as well then?
Yeah, we have been. The way that we look at the dollar is where's the best relative economic growth and which central bankers globally are going to be continuing to tighten the most. And because of the relative strength we talked about here in the U.S., we think that's the U.S. Federal Reserve. We think the U.S. economy is doing the best. We also think if a recession unfolds, which is our base case, there should be a bid for U.S. dollars. I don't know that the dollar goes gangbusters like it did in the first few quarters of 2022, but I would say I would fade any weaker dollar trade here.
European markets on another planet. That's the headline from Emily Rowland of John Hancock. Whether you intended that to be the headline or not, it will be. Emily, thank you. Have a good weekend. Thank you, Emily. The euro right now, 109.92. Tom, European stocks, the Euro Stoxx 50, up something like 15% year to date. Not too far off what the S&P 500 has delivered.
We'll state that of all the different opinions we have on the show, the one constant theme has been surprise over Europe in the last 6, 8, 10 weeks as well. I would still suggest that we underplay the war reporting that we see day by day in Ukraine. It should be more in the discussion than it is.
If you are just tuning in, welcome to the program. The equity market right now on the S&P 500, negative by 0.05%. Coming up in about 48 minutes from now, Anne Milletti of Allspring Global Investments to weigh in on this equity market so far in this rally year to date and whether we can get that continued broadening out away from tech to the cyclicals. Bit of breaking news in the last 10 minutes, Tom. This from Sky Sports. Harry Kane now has permission to fly to Germany and undergo a medical at Bayern Munich.
Was that a Brexit thing?
$100 million plus transfer is set to go through between Tottenham and Bayern. A Brexit thing. I think that was Daniel Levy getting on the phone and trying to hammer out a few more details thing.
Explain to Americans who don't understand why Lionel Messi's in Miami, explain where Byron fits in.
What do you mean? What? Can you reframe that?
There's a lot of Americans that
they
this is
love
all
this
like Greek.
sport.
No, it's all Greek to
do.
most of us. We're worried about if the Reds have enough to get a wild card slot in the National League. John, who is Byron? What is the importance
Us
of
dumb
this?
Americans don't know anything. And you
No,
and then I've got to sit here and talk down to everybody.
Exactly. You
wouldn't
tell
know.
us exactly what we should be paying attention to.
I wouldn't know Byron from Dortmund if it hit me over the head. Who is Byron?
Heavyweight European football club based out of Germany.
They're like Real Madrid.
Well done.
They're like AC Milan. They're like Barcelona.
They're up there. They're competing for the top titles in European competitions every single year.
So when he plays a friendly or a UEFA, whatever it is, championship
that's not a
game
friendly, but yeah.
in England, that will be a big deal. The return
If he
of
plays
Harry
a
Kane.
Champions League game in England, that would be a huge deal. Particularly if he got to go home and play Tottenham. But you need to qualify for these competitions, Tom, first.
I'm learning every day.
Compete to try and win stuff. and all of that. Vishy Tripator of Morgan Stanley joining us in about 20 minutes from New York City. Equities negative. Good morning.
The goal of this executive order is to make sure that we're limiting the ability of financial flows and the know-how that often goes alongside those financial flows to give countries of concern the ability to get around the things that we're trying to prevent them from getting access to, like the most advanced semiconductors.
That country of concern in this instance is China. That was Wally Adeyemo, the US Deputy Treasury Secretary, following the executive order from the President of the United States on outbound investment into China, trying to curb that, curtail it. The president also had something to say about China at a fundraiser in the last 24 hours. Yesterday evening, he referred to Communist Party leaders as, quote, bad folks, and went on to say, Lisa, this economy in China is, quote, a ticking time bomb. And that speaks to the data we've had out of China so far this week. Whether you'd quite go that far and characterize it as a ticking time bomb is up to you. The data on the loan side of things, Chinese banks extending the smallest amount of monthly loans since 2009. Lisa, this going together with the deflationary data early this week, it doesn't look too good over the last week.
And it raises a question of what China's going to do about it. And Peter Scheer was talking about that yesterday. And President Biden hinted at that as well. They're not going to take it sitting down. How are they going to try to generate growth? Is it going to be in other economies? Nonetheless, the message, the headline of, basically a ticking time bomb and bad folks is perhaps a little bit different than some of the conciliatory moves by members of his cabinet, as well as some paring back.
Does bad folks sound like an insult to you? Bad folks.
I would not want to be called bad folks.
Bad folks.
Okay, well, I mean, it's like trying to gather a certain type of tone ahead of a campaign.
What would that tone be?
We're not in it for China, basically.
Bad folks.
Yeah, bad folks. Well, you would never call someone bad folks.
That's so
that's
soft.
an insult.
No one calls anyone a bad folk.
If you come around here again, you're a bad folk.
Bad folks, TK. Bad folks.
Bad folks.
Bad folks. You got to speak, Tom. It's radio.
It's radio.
It's
you got to
radio.
speak. Good
This is
morning
what
on
you do.
Bloomberg Radio.
You get the microphone.
Thank you.
You engage it and you talk. I've worked with you for a long time. If you're just tuning into this program and we're still keeping you, thank you. TK does this thing, and you have to know about it because it's really important. In radio, if you miss your cue and there is a moment of silence and you pick up and start talking, you own it. It's yours, because to the audience, you missed your cue. So what Tom does when he misses his cue and doesn't speak is he waits for someone else to own it for him.
The reason we do this is important. Jeanette Lowe's gonna have some patience here for us. This is really important. There's two kinds of people on TV: people that have done radio and people who have not done radio. And to John's point, which he's brilliant on, is silence is everything in this business. So when they're doing that, and I'm sitting here looking at the Red Sox, they got no chance against the Mariners. And the bottom line is you use the silence for showbiz and you extend it.
Yeah.
And then give it to someone else.
Yeah, and let someone else own it. Yeah.
Like that. Let's break the silence here with Jeanette Lowe, never silent, Managing Director of Policy Research at Strategas. She was at Richmond years ago at the Jefferson Hotel with that acclaimed Jefferson statue, and she figured out that if you make a law in Washington, everybody piles on and enhances the law. And your research note, Jeanette, I think is absolutely brilliant about now we're making policy about China. The president is making policy. Will we see Congress in various forms pile on and make our policy with China ever more limiting and restrictive?
Yeah, absolutely. So, I mean, we finally got the executive order that Biden has been heralding for quite a few months now. So we knew this was coming. It was definitely a little bit more limited in scope than originally thought. And you could already see members of Congress starting to put some messaging out both before the executive order actually hit and after it. And so what you see is that the administration is saying that they're going to focus on targeted products and services within AI, semiconductors, quantum computing. But the Treasury is going to now issue those rules, and it's going to take some time to be implemented. Congress is already saying, Senator Schumer has been on wanting to do legislation on China for quite some time. He's immediately said that he wants to now codify these restrictions that came out of this executive order and refine them. You have members that are on the U.S.-China committee. So you have members that are, the head of the Foreign Affairs Committee already saying they don't think that the executive order goes far enough. It should include other areas. So this is still the beginning stages. We still anticipate that we're going to see more coming out of Congress that's going to build on these restrictions. So even if we have this executive order now that we've been waiting for, there's still more to come, and they're going to still refine it, as they said in the executive order, kind of taking a look at what are these notifications of various use investments that we do have in China, and then figuring out where they may actually need to do more restrictions in the future.
Jeanette, some people are saying that the restrictions were severely curtailed from their original form and are actually very narrow and much less restrictive than previously thought, and that the reason why President Biden talked so harshly about China was to sort of distract or send the message that he was harder than his policies actually were. Do you agree with that type of sentiment?
So I think that the administration is trying to probably thread a couple lines. One is, the U.S. is also, as you mentioned earlier, Biden is going into campaign mode. You're going to have these speeches and these talks. Obviously, this wasn't a speech. This is more of a private fundraiser. But that they want to start showing that the U.S. economy is doing quite well and make this contrast with China. There has been the push that, maybe Biden isn't being tough enough on China. But there is this, we're trying to move it in stages and then build from there. So I think that to some extent, he would probably like to do more and faster. And that may be some reason behind some of his comments. But I think he also is trying to draw this line between the U.S. actually doing better and China not doing so well, but that we also need to do this for national security reasons.
I look, Jeanette, at China and what is assumed to be the response out of Washington. What will it mean for American business? Is this a political exercise, or can you bring it over to the total dearth of FDI that we see towards China?
Yeah, I mean, this is definitely one concrete step that we are taking, but at the same time, the administration is sending a message to businesses that China is more of a risk than it has been in the past, and that there is more of an effort that companies need to undertake if they are going to continue to do businesses in China. And the U.S. also wants to highlight some of the issues that we've seen with companies investing in China over the years, with joint ventures, having to give up data controls, things like that. But there is definitely, I think you're already seeing, yes, we've had the CHIPS Act pass, but some of that funding hasn't even come out. You're seeing investment move to the U.S. already ahead of that. I think this executive order, even though the rules aren't in place, is still putting forth that environment for businesses where they have to reassess whether or not they want to be in China, take those risks into account, and consider moving supply chains or all of their business out of China overall, because more of these changes are coming.
Hey, Jeanette, wonderful to get you on the show. Come back soon. Jeanette Lowe there, a Strategist. We appreciate it. Important to note, and we did this in the previous hour, but I think it's important to double down on it. These comments from the president came at a fundraiser, Tom, a fundraiser to donors in Park City, Utah. And this is what it's about now, to raise money for both the Democrats and Republicans. This just seems to be a box you've got to tick on a campaign trail. You've got to say things like the president said yesterday evening.
Playing to a domestic audience, and of course Beijing knows he's playing to a domestic audience, but they're going to use it for their own needs internationally and domestically as well. But yeah, what's unique here, and I thought Jeanette was just brilliant there, on the bipartisan nature of this. If Congress piles on and makes it more, just to use a general phrase, restrictive, who's going to push back? Who's going to say, let's think about this before we act?
You've made a couple of points there, Tom. I'm so pleased you made the first point, because so much of this is for public consumption. Publicly, China said they were disappointed by that outbound investment order. I think privately, they're probably a lot happier. It was more narrow than it could have been 12 months ago. So even for them, Tom, and you've made this point, it's for public consumption.
It's all, yeah,
we're disappointed. We're disappointed. But at the same time, Lisa, how much has changed?
Yes,
Although if you look at the data, and this to me really stands out, you're absolutely correct, by the way. Everyone would agree that basically the rhetoric has to be hardline, and then underneath there's the reality of needing a little bit of working together in order to keep both economies on the rails. There has been a divergence, though, between these two economies, which really goes down to the fundamental question of why have we not seen more of a read-through in the U.S. economic data with respect to what's going on
We'll
in
continue
China.
this. Catherine Mann, I think, is brilliant in this. We'll talk about it here as we stay with us, folks.
Is Catherine Mann going to come on the phone? From the Bank of
We're
England?
not going to get Catherine
We're
Mann
gonna
on the
make that
phone,
happen.
but her work on China-U.S. codependency is definitive.
It'd be good if we can make that happen, though.
I'll get the
One day.
interns on it.
One day. This year to the tour of Morgan Stanley on the fixed income market, on the bond market coming up shortly. Your equity market basically unchanged. From New York, this is Bloomberg. Let's get you to the weekend. I'm going to stop saying that now.
You said that like
Four.
It's
Wrong
like,
four.
where's
Wrong
my
four.
Tang?
I've got like a sign that holds
Every
up
time
four.
John says that, I'm going to have a sip of Tang.
This is for the London desk who might be playing a drinking game before they go to the pub. Just maybe. Maybe this is just for the audience in the City of London.
Someone dared you, didn't
who
they?
are ready to call it a day at midday.
Is there anybody in
Maybe
the
it
city
is.
of London in August?
Right
is
now,
it like
on
Paris
a
where
Friday?
everybody exits?
Did you see that meme? How funny was that?
Yeah.
About the US economy. It's like this guy calls this other guy and calls up and says, US economy's doing great, inflation's coming down, GDP's brilliant. You know, speaking down to the European market participant, and they just get an out-of-office reply that we're out of office until September 20th. Love that.
The heart of the matter there, John, is because I know we got to move forward. France has the same productivity America working, I believe it's
Yes.
18% less. That's the math, folks. It's irrefutable.
Can't fight it. Can't fight it. Under surveillance this morning, the latest out of China. China's economy showing further signs of weakening. New loans from Chinese banks in July plunging to the lowest level since 2009. Just adding this week, TK, to a slew of recent negative data out of the world's second largest economy.
Read in this weekend. There'll be lots to read about this. It's important to be informed about the nuances. I'm going to go back to the heart of the matter, which is people look at this China, America, China, China, America, China, baloney. Look at Vietnam. Look at Malaysia. Look at Mexico. Look at a good part of South America. This is a more complex discussion than the simplicity the politicians speak of.
President Biden calling them bad folks, but it's been bad data all week.
And how much does this lead to a real shift in the strategy by China? And I keep going back to what Pete Scheer said of Academy Securities when he was saying you're going to see Chinese companies try to compete more directly with U.S. companies in Latin America and Africa. There is going to be some new sort of alliances that are drawn more severely that I think are going to have to come to the fore.
Quote of the week. Quote of the week. Can we start doing that? That would be fun. Quote of the week this week came from the President of the United States, and it was not about China. It was about the Inflation Reduction Act. You could not make this up. Republicans could have written this for him. He said he regrets the name of the Inflation Reduction Act, saying it, quote, has less to do with reducing inflation than providing alternatives where we generate economic growth. He said a little bit more than that, but Lisa, ultimately, wasn't that the complaint on the other side of the aisle down in Washington before this got passed?
So everyone was saying it was called the Inflation Reduction Act to get it passed, because how can you vote against the Inflation Reduction Act at a time where you've got the fastest pace of inflation going back 40 years? Who's going to fight against bringing down inflation? And now people are wondering how much this is actually fueling some of the sustained growth that we've continued to see. Look, I mean, either way, he's saying the quiet parts out loud, right? And the issue is it is fueling some growth, and he's trying to now put the emphasis on that because
he wants to earn the growth because inflation's coming down.
Yeah, because inflation isn't necessarily the plan.
I think the president could go on Wall Street Week with Larry Summers. It'd be interesting.
That would be a great conversation, wouldn't it?
To see the balance here between inflation and growth. That's always what it's
I'm
about.
not sure the president wants actual questions at the moment.
I'm not.
You know how that works.
Go there. I'm in the Jeff Curry timeout chair as it is.
Well, you're in trouble for that comment.
President,
yeah. Okay. German Ford recovering a bit this morning. Yesterday, the biggest one-day loss of the year so far for the likes of General Motors. This drop coming on concerns that demands by union leaders could send labour costs there absolutely soaring. Labour power in the last couple of weeks back on the agenda, Lisa, even as we talk about disinflation more and more day after day.
And it has been, but it's been building. And this idea that suddenly the new playbook for so many investors is going to be looking around which companies are most susceptible to organized labor and pressures to increase costs. For each of these companies, it was what, $80 billion in extra cost for each of them if some of these demands were brought to the fore. I just want to say, even for companies, though, who do not have that kind of union pressure, what does it do to the wages that they need to offer if you can get that kind of wage growth? If you can get $170,000 to be a truck driver at UPS, what does that do to FedEx? What does that do to others?
To Tesla, you think it can have an impact?
Tesla is a bit of its own animal, but there is this question around what the broader impact is when you can get that kind of competitive wage in the place.
So here's my question. Are they hiring? They're putting up wages for union workers at UPS. We're seeing a big deal there. Are they going to be hiring truck drivers anytime soon en masse?
It's a good question. In other words, are they basically in a vacuum where they're paying people more but not affecting the labor market in a material way because they've got no choice? I don't know the answer to that, but there was a story talking about how FedEx is getting increasing pressure, and all of a sudden other workers in that same industry are starting to raise a lot of pressure. So even if they aren't hiring and affecting the labor market directly, indirectly, there is a pretty significant impact on increasing wages.
It's been a massive conversation. You've seen the memes out on X, on Twitter, UPS drivers driving Lamborghinis and all of those kind of things.
I mean, in fairness, it is a living wage with some of the increases in prices, depending on where you live. It's more than that in some places. But it's trying to harken back to the 1950s or a time where
why are you looking at me when you harken back to the 1950s?
One person, I'm going to look at nobody. I'm going to look at you. When one person could go to work and then support a family. You can't do that anymore.
One vignette. I'm in Davos. It's freezing out. I'm with a CEO of a fancy health company.
So in touch with the people.
John, the CEO of the health company said 1/5 of my people can't afford to get to work every morning.
What was his bonus that year?
Oh, his bonus was huge, but he tried to fix it, and he got a lot of board pushback here on the atomization of labor over the last 20 years.
Drives me nuts about Davos. That does.
Well, we're going to go back, and we'll be more ecumenical than that. We ready to go here?
We are.
We have an important guest here on a Friday morning. Vishy Tirupati joins us, Chief Fixed Income Strategist at Morgan Stanley. We had on Vishy Alexander Goldfarb, real estate axe at Piper Sandler the other day. He's quoted in Cranes on SL Green and what's out there, which you nail in your research note. We have ahead a massive refinancing. What's going to be the ramifications of refinancing in this new environment for fixed income?
I think you're specifically talking about, commercial real estate. There is definitely a refinancing challenge ahead of us. But I think there are significant and important nuances that we need to take into account. I think in terms of type of properties, in office properties, there is clearly a secular change in terms of flexibility from working from home, et cetera, that has reduced significantly the demand for the office space. So there is a significant headwind for that particular property type. But you look at some of the other property types, whether it's multifamily housing, industrial, commercial real estate, et cetera, the challenges are not exactly the same. But I think the bigger issue in my mind is really that from a lender type perspective, the biggest exposure to the commercial real estate as a whole is in the smaller regional banks that also happen to be the weakest link in the lending chain. So that is the real challenge, not commercial real estate all around. There are important nuances to focus on.
If there is fear, and if the pendulum's swinging price down, yield up, which type of fixed income instrument is an uncommon value right now?
I think there are a number of places we would point to. A lot of the senior tranches of securitized products that have actually fallen out of favor because of the bank demand for these products has fallen off, and that has clearly kept those spreads much wider. So there's a range of such senior tranches of various securitizations we think are pretty attractive. We continue to think that the higher quality fixed income, including treasuries and high quality investment grade, continue to offer reasonable returns going forward.
What do you make of what Emily Rowland was talking about earlier of John Hancock, where she was saying that some of the price action in bonds doesn't make a lot of sense this week, considering that we got disappointing data, we actually do have disinflation, and suddenly people are gaming out higher inflation for longer and a Fed that backs off way too soon? It's a head scratcher for sure, because yesterday's data, we had inflation surprising modestly to the downside, well in line with the trajectory is well in line with what we think is going to be a lower inflation print for the next few months, the next several months. The expectations of the budget deficit numbers that were the monthly numbers were a bit of an upside surprise, but we think that how much that one specific number played out in the market seems like a vastly overdone in our minds. I think the narrative that has taken hold in the market, which we disagree with, is that the term premia are going to be higher for longer, and we completely disagree with that notion. So if that's the case, have you been buying 30-year treasuries en masse? Are you basically seeing this as one of the best buying opportunities that you've seen in a long time? We're definitely suggesting investors go long duration. We think the five-year spot is the sweet spot at this point. We've not yet made the call on the 30-year part, but I think all of these types of sell-offs, that we are seeing in the market, we think of them as opportunities to go long treasuries. We think, as we will see a more dovish tone coming from the policymakers over the course of the year, and the market narrative we think will shift in favor of being long duration. Interesting. Just starting to hear that a little bit more from Fed officials in the last couple of days. I'm thinking of John Williams of the New York Fed and the New York Times earlier this week. Vishy, love to catch up with you. Going into the weekend, thank you, sir. Have a good one. Vishy Tripatur there of Morgan Stanley. Sometimes you've got to stay on top of ridiculous stories, and I think you're all familiar with the prospect of a fight between Elon Musk of Tesla and Mark Zuckerberg of Meta, respectively. Mark Zuckerberg said that he'd offered to have this cage fight, if you want to call it that, on August 26th. No sign of a date being agreed here, but Elon Musk saying this moments ago, the fight will be managed by Mayan Zuck's foundations, not UFC. Live stream will be on this platform and Meta. Everything in camera frame will be ancient Rome, nothing modern at all. I've spoken to the Prime Minister of Italy and the Minister of Culture. They have agreed on an epic location. I'd love to hear what the Italian Prime Minister Meloni has got to say about all of this happening, Tom. No date. I thought we were getting a back scan earlier this week. Weren't we getting a back scan? He might need surgery. How did that go? Still don't know.
Lisa's like totally on this story.
That post came out just seconds ago.
Is this to raise money? Ago. I'm lost. Is this to raise money? It's that they challenge each other. Didn't Elon Musk originally challenged Mark Zuckerberg to a cage fight in direct response to the creation of Threads? And Mark Zuckerberg basically said, bring it on. He's been training. He looks completely jacked. He's shredded. And Elon Musk is not. And then they're talking about possibly doing this. I personally think Elon Musk is the chief executive troll of the world. Because at what point is he being serious? I mean, ancient Rome? No idea. We have no clue. Maybe he is. Okay, but we need Scarlett Fu, surveillance culture correspondent, on this. And I would, she's like third wired into all of this. And I would say she's an ice hockey fan, not a UFC fan. Whatever. I would say to Scarlett, what's the why of this? How did we get here, Mr. Ferro? Well, I hope that we can raise some money for charity. And if it goes to a good cause, that's a good thing. Yes. Who are you? Yes. That's a good thing, isn't it? No? Sure, but that's not the point. Was this like a dare? The point here is Elon Musk was mad at Mark Zuckerberg. Somehow Mark Zuckerberg starts looking good. He was the most unpopular figure in corporate America. Suddenly, maybe not. If you're just tuning in, welcome to the programme. The S&P 500 negative here by 0.1%. Coming up in about 45 minutes from now, Andrew Hoddenhorst of Citi. Andrew, looking for the potential of inflation re-accelerating and reintroducing the risk of more rate hikes maybe into next year. He's in the Neil Dutter camp, or maybe Dutter's in the Hoddenhorst camp, but they're in the same one. I would say for Global Wall Street, this is the Friday interview. We need to really listen to Dr. Hoddenhorst here about the sticky inflation, or dare I say lift in inflation. That's an outlier call this Friday.
Conversation on retail coming up. Looking forward to this. Lots happening in that space recently, particularly in luxury. Joe Feldman of the Telsey Advisory Group looking ahead to retail earnings. We'll catch up with Joe in just a moment. What's Joe got to say recently, Tom?
Joe's readjusting on big boxes as well, and Dana Telsey was definitive this morning on the Coach Michael Kors transaction. We can talk about that.
What did Dana say?
She said that they underpaid nicely versus the gross overpayment for Versace of years ago. The stupidity of buying James Chu and Versace at huge numbers.
Or James.
Oh, it's Jimmy? I didn't know. Sorry, that was James.
We call it Jimmy. Jimmy Chu.
Excuse me.
Say we loosely, obviously. Equities negative here on the S&P from New York. Good morning.
I don't think the Fed has done enough. And I think the Fed is kind of enamored with this soft landing view. They're almost wish casting this outlook. And I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up, sometime next year.
We are definitely borrowing that. Wish casting. Neil Dutta, head of US economic research over at Renaissance Macro Research, who thinks there's real potential for this economy to reaccelerate and take inflation with it, questioning whether the Fed's work is really done. Let's turn to the price action for you this Friday morning. Good morning to you all. And the equity market on the S&P 500, equity futures down by 0.1%. The arc of earnings season, I think you all know it well. The banks go first, then comes tech. Personally, not a big fan of the bank earnings story. I like tech because it has such big weighting on the S&P 500. Then I like to turn to retail towards the back end. Retail target on Wednesday. So next Wednesday target, Tom. Day after on Thursday. So next Thursday, August 17th, you'll get numbers out of Walmart. So retail takes over the earnings season for next week.
They're different, too. They're nuanced. We're going to get to that with Joe Feldman in a moment. But, John, I totally take your point. It's like UPS. It's a spread of the nation, FedEx or whatever. But to me, they're each different. I think the financial media lumps them all in like we do with tech. They're all big box, all the same. And the answer is they're not.
Different weightings to merchandise and apparel and all of that stuff, and food and grocery. It all matters.
On a Friday, to brief you forward on this and into next week, Joseph Feldman joins us, senior research analyst. He's working with Dana Telsey at the Telsey Advisory Group. They've been on fire the last 48 hours. Joe, I want to get to big box, but I really want to frame out the difference here. At Target, I've got a women's boxy zip-up denim jacket, Wild Fable blue denim, for $35. That's what you're looking at. Your colleague in crime, Dana Telsey's, looking at the Medusa 95 Dua Lipa denim jacket over at Versace for $1,350. When all this is done 3 years out, is there going to be anything left in the middle between Coach, Kors, Versace, or LVMH and Target? What's the middle end up doing in the coming years?
Yeah, the middle is kind of squeezed right now, and that's where we're seeing that middle has been trading down, and then the upper end is kind of staying where they are. It's that aspirational customer has traded down a little, the middle has traded down. So I think that still positions Target and Walmart pretty well. Dana, I think, likes the deal with Tapestry and Capri in the sense that you can bring these two companies together. They're a house of brands. And I know they're more of those middle aspirational type brands, but you can operate them more efficiently. And maybe the way you allocate resources to the different brands and do the back end can make it more profitable and make them more of a stronger venture to go forward. So I think that we kind of like that lineup and the strategy there. And, honestly, the Capri side has been kind of languishing for a little bit. And so I think that now if you put it together, you could maybe make a go of it, make it stronger. That all said, the near term, the consumer is still under a lot of pressure. Discretionary sales have been slow, and especially big ticket discretionary sales have been slow. And so that's where we're at heading into this earnings season and why we like Walmart into the earnings season.
Well, Walmart year to date outperforming Target by a massive margin, underperformance from Target, outperformance from Walmart. Joe, there's a word I really don't like around the retail names. It's shrink. Why don't they just call it what it is? Theft. And how much are we going to be talking about that next week?
Yeah, I think we're going to hear a lot about shrink next week. Target has laid it out and told us, they're expecting around $500 million of incremental shrink this year. Walmart's got a big number as well. Now, they haven't quantified it, but it is big. And Home Depot and Lowe's and Best Buy, and you go down the list, and it's been a big problem for everybody. I mean, theft has really kicked in higher. You know, the shrink side, yeah, there's always been damages, returns that you can't really sell, things that maybe walk out the store with an employee every once in a while, things like that. But this organized crime that's happening in retail is really a big problem especially for these big box retailers. You know, Dana actually recently was in Beverly Hills and witnessed it firsthand, one of those grab and goes, somebody just running out of a high-end store and literally right in front of her. And it's frustrating to see, and it's scary for the average consumer to see that happen.
And it's something that we've seen particularly with respect to a lot of drugstores, particularly in city centers. I'm wondering how much this pushes the emphasis then on the online presences of some of these companies. And I think of Walmart in particular, which is actually putting up competition to the likes of Amazon with what they can offer in e-commerce.
Yeah, absolutely. I mean, the e-commerce side of the business at Walmart, at Target, really many of the big boxes have improved significantly. They're very robust. And, you know, we see Walmart as going toe-to-toe with Amazon, especially on the retail side of the business. Clearly, Walmart doesn't have AWS. But on the retail side and the physical presence, to leverage the physical with the digital is a real advantage, especially relative to Amazon at the moment. Now, Amazon wants to get more physical. They're trying to open grocery stores. I think we'll see that accelerate once they've kind of figured out the box that they want. But there's definitely, this conflict is going to be around for a while. And you can get great value at both of these retailers. Add in Target, add in Costco, add in all the other big box guys. And you're absolutely right. You know, that is a way around this. We have seen e-commerce sales decelerate a little bit, you know, broadly speaking in retail, as people have returned to the stores a bit more. But that's definitely a strong area of opportunity for the retailers going forward.
Walmart's kind of a confusing read on the U.S. consumer, because on one hand, if it does well, that's a good thing. People are spending money. On the other hand, it's been people who are trading down, who are trying to spend less, who are going from Whole Foods or Whole Paycheck, as Tom likes to call it, to Walmart and looking for a bargain. So is Walmart's gain everybody else's pain? Is it sort of a counter indicator of consumer strength?
Well, that's a great point. You know, that it is an indicator of where the health of the consumer is. Now, the good sign is the consumer is still spending. They are trying to save money. They may be trading down. They may be trading in. But Walmart has done a really good job over the past few years and making their business model stickier. And so they're retaining a lot of those customers. So they've seen trade down and trade into the business, but they're seeing those people stay. So yes, that's not great for the rest of retail. It just shows that Walmart's gaining market share. But some of their latest formats, like especially the ones over in New Jersey, if you just cross the river, they're really phenomenal stores. And they're very much Target-like, to be quite honest. It has that little slightly more upscale feel, really goes after the core American consumer. And you're absolutely right. We are concerned about how things will shape up, especially for that middle-income consumer. For this holiday season.
So, Joe, we talked a little bit about the prospect of trade down to Walmart. We've heard that over the last few quarters from the company itself on the earnings call. Joe, what about holding on to talent? We've seen a bit of softening in the labour market. You're talking about maybe the economy deteriorating. Do they have that issue on the talent side? Do they have a UPS problem? Do they have a problem like GM, Ford?
I don't think so. I think Walmart and Target and all these guys have done a really good job over the past few years of trying to pay their people better, to raise wages, starting wages, I should say, and raise the average wage for everybody. They've added more benefits to their consumer, to their employees, and you know they've done a much better job with that. And we haven't heard as much of the griping that we used to hear a few years ago, especially around Walmart or Target or some of the others that, you know, employees felt, you know, underpaid.
I ask for obvious reasons, Joe, and I'm jumping in because we've only got about 60 seconds left. I can only imagine how difficult it would be to work at some of those stores in certain locations, at Target, at CVS, when you're seeing people come in, clear off the shelves, and you're told that you can't intervene, you can't do anything, you've just got to step back and watch it. What's happening to those locations? Are they just being shut down?
Unfortunately, some have been. I mean, you saw Walmart shut down a couple of stores in Chicago. Others have shut down stores in San Francisco. in other parts of the country. The retailers tell us there's definitely isolated pockets and they're limited to certain stores. It's not everywhere, but it's a concern, and it's scary for employees. It's scary for the shopper while you're there. And it's very frustrating too. I mean, we keep hearing stories of employees that occasionally, step in and when they're told not to, and yet it's just so frustrating to them that they step in and try to stop it. And some have actually lost their jobs for doing so because, it does put them at risk. It puts the company at risk and puts everybody, the shopper at risk as well. So it's best to let the people go, but very frustrating for sure.
Some shocking images. Joe, thank you, sir. Joe Feldman there of the Telsey Advisory Group going into earnings next week. Tom, from the likes of Target and Walmart, Wednesday and Thursday.
Well, I'm glad you brought this up. It's an original landscape. I totally take your point on shrink as being a homogenized theft as well. To me, and this is in New York, it's a huge issue. You go into the store, little plastic windows with a little bit of keys, turn around, go out, order it online. That's my response. I think it's a changed landscape, to say the least.
Anne Milletti of Allspring Global Investments coming up, live from New York City. Good morning.
The economy's been pretty impervious to the Fed's increase in rates.
Sooner or later, this economy will stumble.
We are seeing deterioration in broad fundamentals.
Right now, it still feels like the economy is doing a bit more than they would be comfortable with.
I think the economy is growing above trend. I don't think the Fed has done enough.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. It's just Friday is what it is here. It is a Friday in the summer, and we are recalibrating forward to August, into September, on our way to Jackson Hole. And the big change this week, John, disinflation. It's out there somewhere.
Endorsing a pause so far for September 20. Does it validate a pivot? I don't think we're quite there yet. You've got some people on the one side, Tom, talking about a re-acceleration. Neil Dutta, Citi, Andrew Hollenhorst, others as well. We'll catch up with Andrew a little bit later this hour, I believe. Others who believe, Tom, that we're done. It is time to maybe go on a victory lap. This Fed, though, perhaps nervous about doing so, embracing that view. Given the risk, the potential, Tom, they might be wrong. And we've been asking that question. What is the biggest risk right now? Waiting too long to reduce and pull back, or...
They always wait too long. That's the history.
Or going too soon.
All central banks wait too long. Yeah, I thought Jason Furman was brilliant yesterday at Harvard. We don't give our opinion out ever, do we? We never give our opinion.
No.
But the debate here this morning is, do you look at a one-year view, a longer-term view, like Jim Bianco, like Andrew Hollenhorst is, John, really looking forward to that conversation, or do you take a more short-termism, 6-month yield? Steve Englander featured on his note the 6-month annualized disinflation.
It's come down.
Yeah.
Steve thinks they're done. Steve was talking about cutting interest rates first quarter of next year. Still a pretty divided view on things. I would say if you're a Fed official and you've got to take that prudent approach, Tom, as a policymaker, where the number one rule is do no harm, do you want to declare victory when you've still got one more CPI print, one more payrolls print before September 20th? Perhaps a little bit too early. We did get a glimpse of it, though. That New York Fed interview, John Williams in the New York Times, I think is somewhat revealing, even though it's incredibly intuitive to suggest that when inflation comes down, if nominal rates are held steady, real rates increase, and we might need to do something about that and adjust. Just entertaining the conversation about rate cuts in any way, shape, or form is a step away from what we've been doing over the last 12 months of the Fed.
The math of the nominal rate less inflation or deflation, there's a whole debate there, to the residual. That was what John Williams was looking at. At least I didn't get to Joe Feldman on this with Amazon, but they're going to blow up their grocery business. And I would suggest a lot of people listening and watching this are saying, okay, you can have your bow tie wonk inflation debate. It doesn't matter. I'm getting killed at the grocery store. That's the emotion out there, that even with disinflation in the wind.
Which raises this issue around commodity prices. And we've seen some of the oil prices climb up and gasoline prices climb up. And all of a sudden, when does that affect sentiment? But it kind of feeds to the deflation debate, right? If people are feeling like prices are just too high, when do they start pushing back? Do companies still have the same kind of pricing power?
That, to me, is the key.
And John's been asking it. You've been asking it. But this, to me, is the question at a time when prices are so much higher on a relative basis They can't keep creeping higher at this kind of pace. So have we seen that? Not in every area. You still see hotel prices. Have you tried to book a hotel recently?
They're insane.
I know.
It's worse than airlines.
Constantly doing vacation planning.
It's
sort
like,
of, you know.
You're very European.
Bramo's so Euro now. It's great.
She's like Euro.
It's brilliant.
She's on a first-name basis with Hartsfield baristas. That was good. I mean, but the hotel thing is more serious. Actually, it's actually absolutely insane worldwide. Of getting a hotel is a battle.
But just pushing this forward. If you do have wage increases down the line, some of the staples, how much does that bleed into higher rates for a lot of things? And the hotels are a perfect example of that because of how hard it was for them to hire enough people after the pandemic.
But the issue here we're having is it seems like forever to the next Fed meeting. That's really what this debate is about. This is the Fed cycle into September after Jackson Hole.
We've got that Jackson Hole split.
It's out there somewhere.
So we should hear from Chairman Powell towards the end of the month for an update. Do you want an update on this? Elon Musk, Tom.
Oh, please.
If you are just tuning in, I'll share it with you. So Elon and this fight potentially between him and Mark Zuckerberg, the fight will be managed by Zuck and my foundations, not UFC, live stream on Meta, on this platform too, X, formerly known as Twitter. Everything in camera frame will be ancient Rome, nothing modern at all. He spoke to the Prime Minister of Italy, the Minister of Culture. They've agreed on an epic location. Everything done will pay respect to the past and present Italy. Preach, Elon. When's it going to happen? Okay, when's it going to happen? He responded to, how was the MRI? On Twitter. I spent 3 hours in an MRI machine on Monday. Bottom line is that my C5, C6 fusion is solid. It's not an issue. Real athlete stuff here, Tom. However, there is a problem with my right shoulder blade rubbing against my ribs, which requires minor surgery. Recovery will only take a few months. You know, when he says stuff, I don't know if he's joking.
Nobody does.
What is he talking about?
He's giving
his
his
shoulder
medical
blade
update.
against his ribs.
What's great about this?
I just think he's
where this
trolling
is
us.
heading, Lisa, is
Where
you,
is it
you
heading?
and I are going to step aside, and this screams Bloomberg, Francine Lacroix,
In Rome.
and John Farrell
In Rome.
from the Colosseum in Rome.
Oh,
you know they're doing it.
I would be very happy to commentate on that. But I imagine Joe Rogan would love to commentate on it too.
I just can see
Rogan on this would be awesome.
I mean, I
So
can
it's
see
Seth
you.
Rogen.
I mean, I can see you doing it. Can you see Francine Lacroix doing a blow-by-blow in the Colosseum in Rome? It'd be great.
All I'm going to say is one guy's shredded, one guy isn't. One guy knows jiu-jitsu, the other one not so much. And the guy who knows jiu-jitsu is probably the one who's going to win, and that guy's Zuck, isn't it?
I
Yeah.
hope they raise a lot of money for.
So do I. I said
for
the same
good
thing.
causes.
So do I.
If
So
they
do
can
I.
buy a college education for every kid in Rome while they do this, that's
Awesome.
That's a really cool thing. We've staggered forward here in the 8 o'clock open on a Friday. We're going to do a data check right now. John and I'll try to stagger through. John, I'm going to look at VIX center tendency. 12, 13, out to 17. Angst, OMG, we're all going to die at 15.75. I'm going to call the VIX center tendency.
I'll keep it brief, Tom. We're down on the week. We're down on the session. We're down about 0.1% this morning. Yields were up yesterday. Soft 30-year auction this morning, Tom. We're down about a basis point on a 10-year. 4.0, let's call it 4.1% on a 10-year maturity this morning.
Right now, we're going to dive into a look at growth and value, or the growthiness of value. We can do this with Ann Maletti, head of active equity at Allspring Global Investments. And I got 8 ways to go here, but I'm going to start with, I looked at one of your large cap value holdings, and your value stock at the top of the pile happens to be Google in this one portfolio. Alphabet. Is tech value or growthy right now?
It's an excellent question, Tom, and I think it depends on the name you're looking at, and obviously the growth rate of some of these companies and the cash flow they're producing. And those are the things that our investment teams are really, really focused on. And so, you could find value in a tech name, whether they're large cap or small cap, depending on the way you look at it. And I think we've seen this throughout. You picked a big name. What I see even more often in our portfolios is our managers steering away from some of the most popular names and into the names that have been, really ignored by the rest of the market.
So some people might say this is the longest losing streak for the NASDAQ. Other people would say, actually, this is a sign that the rally is broadening out and that there's real momentum and strength in the U.S. economy and the U.S. equity markets. Which is it from your vantage point? Is this the beginning of a sell-off that's more protracted or the beginning of a broadening out that can be more sustainable?
It's $1 million question, Lisa. And I think what we really need to do is remain humble. And, we don't have the crystal ball. We don't know. But what we are paying attention to very much is what we're hearing, not necessarily hearing, let me make that clear, but what we're seeing from companies and the actions that they're taking. And what that suggests to us is that there's a lot of fog in the future, and that, it's clear that the future is going to be different than the past, i.e., for sure, higher rates for longer. And that does affect business models. And so we're starting to see management teams adjust to that, which is a good thing. That being said, we think some companies are going to be set up better for the future than others.
Well, how do you view the whole GM and Ford sell-off of yesterday and this question around unions pushing for greater benefits, bigger wage increases, what we saw over at UPS? How much is that trend influencing how you analyze each company?
Lisa, you're hitting on some really important things because you're going back to the fundamentals of companies, which we are very, very focused on. And it's things like labor costs. It's things like, potential deglobalization. It's things like that that really can impact company margins. And, we all know what margins have done over the last decade. Steadily, they have gone up. There's real question marks whether or not they can, continue to go up. We think that's probably not possible, but can they stay where they're at? And I think that's the challenge, and you're hitting on some of those key points. And that's why we're very much focused on bottom-up company fundamentals and, specific stocks.
Yeah, Melody, if I run through Allspring, what I see is, and we're going to get a little mathy here, folks, this is the R squared, the idea of the correlation of a given portfolio to the broad index, usually the Standard & Poor's 500. The fact is, and a lot of institutional portfolios are running active management very close to the index R squared. Where are you on that? Does the active manager need to get more active and disparate from the index? Or should we just all go out and buy the Allspring index fund?
It's a great question, Tom. And I think when you look at it across any asset manager, you're going to see a weighted shift toward a higher number than you'd like. But I think what we're suggesting is you have to get more active in this environment, because if you look at those higher weighted names in the index, not only have they exploded in terms of weighting in the index, but they've exploded in terms of valuation. I was talking to one of our growth managers earlier this week, and we were talking about the Russell 1000. And, he gave me some stats, and let me just read them really quick so I don't get them wrong. But, the PE of the benchmark at the beginning of the year, looking forward, started around 21 times. It's gone to 26 times during the same period, or up about 25%. And if you look at the rest of the benchmark, you could pretty much say there's been contraction in the rest of the benchmark. If you just took away those largest 7 names. And so it's things like that that really make us go, okay, regardless of the macro environment, there are names that are clearly not being treated as equals. And so you need to get more active. You need to look where other people aren't looking and steer away from some of those large bets that you're getting when you just play an index.
Multiple expansion has been phenomenal year today, and thanks for that, Anne Miletti of Allspring there. If you're just tuning in, welcome to the programme. The S&P 500 negative here by about 0.1%. Looking forward to this conversation. I think this is the number one for us, Tom, on the economy. Andrew Honenhorst, chief US economist over at Citi, does not think the Fed is done. He's looking for another hike potentially in November, sees all the ingredients for a re-acceleration in inflation, later on this year. So park your soft landing hopes and dreams. Andrew's going to upset them in about 20 minutes' time.
This is an important conversation. The overlay here just out moments ago from the new Bridgewater, Kate Dunbar, Josh Moriarty, and Nicole Kagan, is the idea of the stasis that Jim Bianco talks about. Is this the new 2% level we're at right now? They talk about this mass extrapolation down to disinflation. John Williams R-starred way, way lower. And what Bridgewater's saying is maybe we're here.
Jim Bianco thinks inflation has bottomed, bottomed for the year. And through the rest of the year, things will get harder. Coming up shortly, Congressman French Hill, Republican from Arkansas. That conversation just around the corner. Your equity market on the S&P 500, slightly softer on the S&P. We're negative here by 0.1%. Yields going nowhere. 4.1% on a 10-year. The weekend, hours away.
Senator Schumer has been on wanting to do legislation on China for quite some time. He's immediately said that he wants to now codify these restrictions. You have members that are on the U.S.-China committee. So you have members that are, the head of the Foreign Affairs Committee already saying they don't think that the executive order goes far enough. It should include other areas. So this is still the beginning stages. We still anticipate that we're going to see more coming out of Congress.
That was Jeanette Lowe of Strategas on that outbound investment order from the president earlier this week, curtailing investment in certain parts of the Chinese economy to some extent, and we'll talk about to what extent in just a moment. If you are just tuning in, we're 15 minutes away or so from PPI data in America. CPI speaking to that disinflationary trend of the last couple of months. Let's see if that shows up in PPI a little bit later this morning. That data drops at 8:30 Eastern Time. Going into that, the equity market's set up as follows. The scores look like this. We're down by 0.1% on the S&P 500. The bond market's steady after the sell-off of yesterday, driven by a softer 30-year auction yesterday afternoon. Maybe some hawkish tones relative to what you might expect from Fed officials, given what the data looked like yesterday. San Francisco Fed President Mary Daly speaking to Yahoo Finance, suggesting there was more work to be done. The bond market's stable now. In the FX market, the dollar a little weaker, Tom. The euro a little stronger. We are just south of 110 on that currency pair.
I'm watching euro yen. John rounded up to 159, 158.93. That's beneath the radar this week, but into the weekend and into the China-Asia opening Sunday, our evening, that's going to be interesting to see. A 160 print there would be newsmaking.
China is on the radar big time after that loan data that we had. And if you missed that and you are just catching up, Chinese banks extending the smallest amount of monthly loans going back to 2009 in the month of July, sparking a bigger conversation today going into the weekend about the prospect of maybe some central bank easing. To Lisa's point, though, does it make a difference in that economy right now? Does it make a difference at all?
I think it's a jumble. I don't have any wisdom on that. What I will say is it is front and center into the weekend. In the zeitgeist, it's about, yes, U.S., China, China, U.S., but also the complexities of other nations as well. We have an expert on this, the banker from Arkansas, the Republican French Hill, joins us this morning. French, you in Arkansas live this. You're absolutely front and center on agriculture. I'll use Tyson's as the iconic chicken maker, and also pork, and the simplicity that's in the political dialogue versus the complexities of chicken from America to China, chicken from Brazil to China, and the stew of it all, not to use a pun here. What is your best policy with China, given the complex realities of a multinational export-import reality?
Well, Tom, Jonathan, great to be with you. Yeah, this is a super complex issue. You know, we're not confronted with a Cold War situation like we had in the 1950s to the 1990s with the Soviet Union, where we were not an integrated economy there. The case is exactly the opposite with China, for Japan, for South Korea, for Taiwan, for the United States, and for the EU. So first of all, I think your comment has to be thought of in a multilateral way, because all these developed economies have supply chain and market revenue opportunity in China. This de-risking that we're seeing, led by the private sector, I think is one of the most important components of why you see concern in China. And I hope that's the case because, in my view, economic deterrence to Beijing is one of the most important things that we can do on a multilateral basis to keep them from being provocative vis-a-vis Taiwan or the South China Sea. And I think that's a key point.
French, we're thrilled to have you on, as you are the only Republican that will not be debating here at the end of the month. It's good to see at least one Republican won't be up on stage. But French, can all of Washington, Democrat and Republican, the bipartisan China view, can we have an adult, multilateral, and complex discussion? Or are we just going to end up with silly simplicities that we hear and listen to now?
Yeah. Such a good point. And that's why I think Mike Gallagher, who chairs the China Select Committee on behalf of Speaker McCarthy, has got a good worldview. He comes from obviously a military background, but he understands these global capital market and trade market complexities that are multilateral and not solely with the United States. And that's why I was glad to see the G7 countries think about a reverse CFIUS type approach at the G7 meeting. This is the essence of where Joe Biden's going with his executive order yesterday. I do agree that I think it's more complicated. I don't think it goes far enough because everything in China is a dual-use technology, and that's how they operate. So it makes very hard for us to monitor and think about how to limit capital flows or technology flows into China.
That's the China story. There's a very big domestic story that was highlighted last week by Fitch that a lot of people are discussing, especially in light of the auctions, which were okay to poor as the week went on. One thing that Michael Zezas of Morgan Stanley said in a recent note was, we're taking seriously the risk of a government shutdown this fall. Do you think that a government shutdown should be on the table in order to reduce the deficit?
Well, Lisa, here's my view. The House is behind the curve here. We need to pass the other 11 appropriations bills that we did not get to in July. We passed one. We need to pass all 12. That gives us the maximum negotiation capability on behalf of the House of Representatives with the Senate and with the Biden administration to get the kind of spending deal that we anticipated from the debt ceiling negotiations. We want to hold the line on that. And the best way we can do it is to get our work done on the appropriations bill in the short time remaining. Those conversations are going on every day. Secondly, look, if we can't get all that done before September 30th, I think a short-term continuing resolution in order to get that work done is important. We don't need to go into a government shutdown when we've done the hard work through the debt ceiling negotiation, and we've done the hard work in our committees, both in the House and Senate, on the appropriations process.
Is there enough unity right now within the Republican Congress members and senators to really get an agreement that everyone can get on board with? Because it was splintered in order to get anything through. Is that one of the big obstacles for you?
Yeah, I think it is, Lisa. I think we are talking with our members every day, as we've done all year, as we've accomplished, I think, a broad set of solid policy accomplishments this year, that some of which have even gone to President Biden's desk. We have to do that on each of these appropriations bills. You've got concern about each one from different members of the Republican conference, and I think that's good. I think it's constructive. We can handle some of that with amendments on the floor, but we do need to get these bills moved forward because, look, that maximizes our negotiating clout, and I would say to my Republican colleagues, if you go to a continuing resolution and don't do your work, what you're doing is essentially institutionalizing Nancy Pelosi and Joe Biden's spending levels of last year and their policy positions, which is not something that House Republicans are in support of.
You know, French, we got to cut to the chase on what matters here. You and I have talked about this before, but if you look at Razorback football, and you look at the schedule of Western Carolina, Kent State, BYU, LSU, finally a real game, LSU and Texas A&M later on. What in God's name is happening to college football, and what are you going to do in Congress to tell these people to get their act together?
Well, let me tell you, Tom, this is all about the money. And those schools love coming to Arkansas. They're going to make a lot of money, and I guess the Razorbacks are going to hopefully have 3 victories in a row. But college sports is now absolutely all about the money. And that's why Jonathan needs to come out here and watch some good SEC football and stop talking about, quote, European football, close quote.
French, I've told you,
Frame it.
French, we're going to make it happen. It's a dream of mine. I want to make it happen. I want to go and watch college football in the South. I want to go and watch it.
To have someone like Congressman Hill tell us it's all about the money. I mean, that's the most shocking thing I've heard this year.
This year, French, is going to happen. Congressman, thank you. Congressman French Hill of Arkansas.
Great to be with you.
Atmosphere's awesome. Just absolutely fantastic. I think the closest thing in this country to European football.
As big a foreigner as I was when the first time I walked in to see Harry Keene play for the Tots, I woke up one morning in Boulder, Colorado, and there was a wall of red of Nebraska. And you sit there as an idiot East Coast kid, and Ralphie comes out in the field, and 30,000 people go mental, and the buffalo goes down the field like a real buffalo goes down, and you're like, and I've got my
marching band starts.
I got my screwdrivers or whatever they were serving me, and I'm like, you got to be kidding me! This is religion. For French Hill, it's religion.
I'm just so basic. I started supporting Bama, which is, just like the most basic thing to do in college
LSU
football. If you don't know what
Razorbacks.
you're talking about, right?
Yeah, even I've heard of them.
I know.
Tells you everything you need to know.
PPI up next. Factory gate inflation, PPI data, just around the corner. We're seconds away from that. Going into it, your equity market, the scores look like this on the S&P 500, negative by 0.1%. Yields coming down just a little bit by a couple of basis points on a 10-year, 4.0861%. The 10-year, 30-year selling off yesterday, yields higher off the back of a softer than expected 30-year auction, following pretty decent demand at a 3-year and 10-year earlier on this week. The economic data drops. This is what we'll do. We'll look at the month-over-month stuff.
Where's McKee?
Just to look at the trend. Do you not want me to do this?
No, please. I'm loving it. That's great.
I'm here just
Where's
to break the
McKee?
news and then go. Mike McKee, it was his birthday yesterday.
What's he going British
He's
on us?
taking a day off. Here's the data. Tom, let's do this later.
Please.
0.3%, so slight upside surprise month on month.
Nailing
The PPI headline. The expectation in our survey, 0.2. If you strip out food and energy, that's also come in at 0.3%. So a slight upside surprise here. The previous number, slight revision there as well. But overall, just a little bit of an upside surprise on PPI data here. CPI yesterday came out bang in line. Looking at the equity market reaction to all of it, equity's a little bit softer, down by 0.2% on the S&P 500, and yields inflecting just a touch higher now. By not even a basis point, but we were down a little bit by a couple of basis points going into this print. Lisa, higher now by a single basis point on a 10-year to, let's call it, 4.11.
This pushes against the people who basically say a soft landing is in the books. And I've got to say, Andrew Hollenhorst coming up next is the best guest to talk to about this, given the fact that you are seeing some of the input prices, the fact that it's not just food and energy. It's also when you strip that out. That said, some of the downward revisions that are coming in do indicate that perhaps on a rolling basis, this is sort of going to average itself out. Ex-food and energy was revised downward 0.1% in the prior month versus the 0.1% gain. So maybe this is all going to be a wash in the end.
Knee-jerk reaction. We'll see if it sticks, but the price action looks like this. Equities down 0.25% on the S&P 500. Yields a little bit higher. Curve steepening just a touch. The 10-year up by a couple of basis points. Dollar stronger. The euro almost unchanged on the day now at about 109.88. I'm going to run because Tom doesn't want me here. Kathy Jones and Charles Schwab coming up in the next hour. Brian Levitt of Invesco, Jay Pulaski at TPW. I'm told Mike McKee is back next week.
You killed it. I remember, John, seriously, I remember like M1, M2, M3 was a big deal. John, there was a point 20, 30 years ago where the world stopped for PPI.
Would you like us to sit here and break the money supply data as well?
No, we don't have to, but all of a sudden maybe PPI matters. I don't know. I thought you did great there. It was like
Thank you. It
was a toxic brew of inflation.
Not my first rodeo. I'll see you guys next week, okay?
Did
Got
they
another
do
show
PPI
to do.
Would
you like to do the Open today?
No.
Would you like to do that?
No, I did it once. You know,
How did that work out?
It was a disaster.
Because I'm on my way out the door, Tom.
But, you know, I look at PPI. Do they have PPI in the United Kingdom? I'm just keeping him here as long as I can.
No kidding. He's literally going to walk off the set.
John Ferro, thank you so much. The Bramo Cam will capture him walking off set. On set right now is our interview of the day for those of you concerned about the persistency of inflation. Andrew Hollenhorst is chief U.S. economist at Citigroup and has been shockingly prescient about elevated inflation, not only in America, but for Citigroup worldwide as well. Andrew, I want to go back to yesterday's free-for-all on 1 year, 6 months, 3 month, 1 month annualized. John's beautiful job there on PPI. Seriously, the granularity of the data. Are we getting way too granular here, Andrew? Are we so desperate that we're just looking at every single tea leaf?
Well, I really think you have to do both here, Tom. And I would say for John, PPI is one of the hardest releases to read. You have a lot of different subcomponents, a lot of different core measures. And we look at all of those things. We look at those things in core CPI also, the super core. We're looking at various measures of underlying inflation, 1 month trends, 3 month trends. So you have to look at the details, but then you have to look back, step back, and look at where is the trajectory broadly in the economy. So looking at the details, there's some upside risk we're seeing. If we look at inflation in August, we obviously have gasoline prices that are up. Airfares are down 20% since March. That's certainly not the experience I've had with airfares. So we think we're going to see those coming up in the official data. That's on the kind of details, the short-term movements month to month. But then you step back and you say, where are we going as an economy? It's an economy that's generating 2% plus growth. It's an economy with a very tight labor market. Wage growth running around 5% by various different measures. That's not an economy that's going to bring inflation back down to 2%. So yeah, we're getting a couple months of softer inflation readings here. That's certainly going to look like a soft landing. I don't think that's where we're headed.
We were speaking with Vishy Turbatur of Morgan Stanley earlier, and he said that the bond market action this week was a head scratcher. Since you got softer than expected economic data, you did get confirmation, at least in the data that we're getting right now, of disinflation. Do you agree, or do you think that this makes perfect sense, that the more the Fed gets complacent, the more concerned people are about longer-term inflation?
Yeah, I think there is a way to make sense of the price action this week, Lisa, which is partly that this soft landing idea narrative and the softer inflation data that's come in was really well priced into the market. Speaking to investors ahead of the CPI release yesterday, it was hard to find anyone who really thought that this wasn't going to be a very soft print. So I think that was already in the price. So then what investors are looking at is some of those details, some of those trends in the labor market, the longer term trends in the economy. And exactly like you're saying, Lisa, if the Fed is going to be finishing up rate hikes and pretty much everyone thinks either they're done or maybe they're going to do another 25 basis points in November and be done, then we're looking at where does inflation go from here, and do Fed officials just need to keep policy rates higher for longer? I think that's a discussion that we're going to increasingly be hearing amongst Fed officials. Is increasingly going to play out in the market, this idea that maybe just the neutral policy rate where policymakers need to leave Fed funds in the longer term is going to be higher.
How much do oil prices, do commodity prices feature into this? I was looking at a Mohammed El-Arian column yesterday saying there's an asterisk next to the disinflation that everybody was celebrating yesterday. And it has to do with oil prices heading toward their 7th weekly gain. Looking at food prices, which are starting to inflect higher, how much do these sort of affect the larger input prices, like the factory gauge ones that we just got?
Yeah, so I think the Fed really got helped out with lower inflation, with gasoline prices coming down, energy prices coming down, food prices that stopped rising as quickly. And we were saying at that time, Fed officials should be a little bit careful in terms of taking credit for that downshift in inflation, because Fed policy doesn't really control oil prices or food prices. And now they may start experiencing the opposite scenario where you actually get some of these commodity prices moving higher, most notably energy prices. So that is something that Fed officials, economists tend to look through to the core measures. But I mentioned airfares before. We're getting higher jet fuel prices. That's going to boost airfares. And that August inflation reading, we could get a month-on-month increase on the headline, something like 0.4, 0.5, 0.6% month on month. So that could really kind of change the narrative in terms of how the numbers are coming in.
Andrew, just a simple question. Are we beyond the pandemic? Are we back to conventional macroeconomic analysis?
So I think we can still use conventional macroeconomic analysis. And I think that's one way that we've been forecasting inflation and thinking about inflation staying higher for longer. The idea that tight labor markets do drive inflation over the medium term. So I think that framework of analysis has actually been a useful one throughout the pandemic and then this post-pandemic period. But the idea that the economy is going to kind of normalize back to where we were, let's say 2012 or 2013, I just really don't understand that analysis. A lot of people would have thought in 2013 things looked pretty different than where we were in 2005. So I'm not sure why there's this belief that we would go back there.
So this is the heart of the question. I'm going to get a little wonky here, folks. This is wrapped around John Williams' R-Start and all the theory mumbo jumbo that Dr. Hollenhorst is really quite good at. The school of thought out there, Andrew, is that we return to a quiescent R-Start, and then there's debate. I'm going to wrap it around what Olivier Blanchard has done, where there's a new higher R-Start set, or dare I say people debt worried, looking at an even ever higher R-Start. Where are you on this? How do you position R-Start out 3 and 5 years right now?
Yeah, I think we have to think about the possibility, at least, that R-Start is migrating higher. And if you take the famous Laubach-Williams model, which to your point, Tom, is full of complexities, and the idea is you're doing this so-called Bayesian update where you look at the economy and figure out where R-Stars. I mean, you can very simply, you can say essentially what that model is doing is saying, if growth comes in higher than we expect, if inflation comes in higher than we expect, then it must be the case that the neutral real interest rate is higher than we thought it was. Well, where has growth come in? Stronger than we expected. Where has inflation come in? Higher than we expected. So that model over time should start catching up to what we've seen in the data that it looks like R-Star is rising. I think we're going to hear about this at Jackson Hole. I think that really could be the interesting conversation that Powell brings up. Now, to your point, New York Fed President Williams, the father of the Laubach-Williams model, I don't think that he thinks that R-Star has moved up yet. He's made comments to that effect. So Powell, I think, can't kind of completely break away from what Williams is talking about. But let's watch Jackson Hole at the end of this month. I think we're going to hear some discussion about the possibility, at least, that R-Star is higher.
How long can the Fed hold rates around these levels, 5.25% to 5.5%, before it causes recession at a time where perhaps growth is still strong, but it's coming down?
Yeah, I think there are lags of monetary policy that will very slowly but surely slow down the economy. We see that in the senior loan officer opinion survey, where you see banks that are still tightening lending standards. You think about many people right now have a mortgage at 3%, 3.5%. Mortgage rates for a 30-year fixed rate mortgage are 7% now. So over time, people will start slowly but surely resetting into those higher mortgages. But those effects that slow the economy work with a very long lag. Mm-hmm. You're not going to be very incentivized to sell your house now and go pick up a new house at a higher mortgage rate. So that will only happen if you have a life event. You change your job, your family size increases. So that does slow the economy, but it takes a long time. So Lisa, it could be quite a long period of higher for longer.
Andrew Hollenhorst, thank you so much. You'll lighten up the airways here. We're getting all sorts of emails here on Andrew Hollenhorst appearing on our lack of disinflation. I just want to say in Bayesian theory, which I'm death on, full disclosure, it's very well understood that Steve Cohen in the 2023 Mets, they used a Bayesian approach. That's how that worked out.
Is that what you're going to call this? Is that what we're going to call the
Andrew's pushing my buttons because he knows
rebuilding.
I'm just death on a Bayesian approach in statistics.
We call that rebuilding, Tom.
Yeah, we will see.
The Bayesian approach.
Right now, a little weakness to the tape here, a little fractional, but we'll take it. The Standard & Poor's 500 down 0.3%.
We did get a lot of feedback from listening to Andrew Hollenhorst over there from Citigroup, partly because I gather he's gotten quite a bit of pushback. A lot of people are believing this disinflation narrative, and he's pushing back. He's saying, stop it. There's going to be a reacceleration. Take a look at, for example, airfares. And this point is salient, not just because I've been focused on it a lot, but, if you have higher jet fuel costs, what does that do to the price of airfares? Can it continue to disinflate or deflate outright?
That's one item. What David Rosenberg, rather, is talking up here some optimism on disinflation. He's been in that camp for quite some time. I know he wrote about it. I didn't read it all, but he read, he talked about it out of Toronto this morning. I'm going to go to where Claudia Sahm is. She's really important in this discussion. And she's sort of set back by her iconic analysis of how you measure recession is being bandied about now like it's a mint. And the answer is she's begging for some humility here. And I really want to emphasize this, that even Andrew Hollenhorst, out on a wing of inflation, has an immense humility over how he could possibly be wrong.
Yeah. You know what humility is? This is probably my favorite story of the week, is that Zoom called all of their employees back to the office and said, you can't work from home anymore. And they're ending their
It's amazing
no-meeting
how many
Wednesdays.
different narratives, as you said this week, end up being about, okay, what are we going to do out of the pandemic about how we work and where we work?
I mean, all of these kinds of transitions, this is where we're kind of struggling to come up with the right model. And you think it's Bayesian? I think the Mets are going to, try.
I think it's mostly kids. They got used to this in the pandemic, and they're like, well, this is fun. Let's keep this going. We're going to keep it going with the data check futures at -7, Dow futures -16. The Dow is Bayesian. We do that for John Ferro. This is Bloomberg. Good morning.
We are about 15 minutes away from getting that PPI report, a bit of a confusing report considering that it doesn't exactly confirm the disinflation narrative. However, pretty much a status quo. What we're seeing in markets was a little bit of softening initially on the heels of that. You see the S&P down about 0.3%. The biggest back-to-back weekly loss potentially on the S&P, Tom, going back to March. The first back-to-back weekly loss going back to May. Is it a pause? Is it something more substantial? It's definitely on the heels of that grind upward in yields. 10-year yields now, 4.14%.
I'm so glad you bring this up. It is a 4 standard deviation plus 2 standard deviation to -2 standard deviation move off of July 28th. And the answer is, okay, is pullback the correct phrase? I'm looking at Standard & Poor's 500, of course, and it's not a correction. That's for certain. Is it? I guess there's a little angst out there. I think we're addicted to up.
That's the key, is that we've been addicted to up. And so when it doesn't happen, it's notable in a year that has been very much in one direction, led by weakness in the NASDAQ. A couple of names that we've been watching throughout the morning, but I think is really important to kind of game out in terms of what the signal is going forward. Ford shares, GM shares on the week, lower by about 6%, give or take. Ford down by about 5.7%. General Motors down about 6.6%. How much are investment managers now looking around at where unions are looking for some sort of negotiations, where they could potentially gain power, where that could eat into margins the same kind of way that we saw in UPS, Tom? And to me, this is one of the key stories as people look forward to where do those wages come out of that so many people are asking.
There's no question the labor discussion is front and center, and it's going to affect some. Now, public sector, it's clearly there. And then maybe it's a new debate back 15, 16 years. Does labor have a new power? I think that's a huge part of the discussion into next year. But also, it'll be about the state of business. And if they continue, I mean, if you have Mari Barra come out, I get upset about this, folks. CFOs, CEOs come on Bloomberg. They talk to us. They talk to Mr. Weston and the rest of it. And they go, we're great. We're minting money. And you're back there as labor going, hello. And I think that's by far and away the greatest emotion.
Well, and that's been basically the story, right? A lot of UAW and others have said, look, if you're getting these bonuses, you got to share some of that. At this point, though, do we start to see that kind of backtrack the past decade, 2 decades, where basically profits came out of the expense of revenue sharing with a lot of employers?
We got any other stocks today? Any retail?
Well, I was looking at Tesla in particular because they are down less than the others, and in part because they have less union ownership. Honestly, I've been looking also at just big tech and how much they've been selling off Apple.
I think Dana Tulsi did a great job on the retail mergers in luxury yesterday. I was really happy with our coverage on that. And you compare EBITDA ratios of the acquisition of Versace years ago, 22 times EBITDA with 9 times EBITDA now, and you can see how it's a value proposition versus perhaps the foolishness of years gone by.
Yeah.
We'll have to see that over the weekend. This is a joy. Manish Kabra is with SocGen, and of course they are acclaimed as founders of French derivative mathematics. He came out of the Bank of America, Merrill Lynch combined with work at Deloitte as well. And he's a first-order excellence in derivatives, the dynamics of the equity market, and we get a brief this morning. What do the tails look like, Manish, right now? Do you have a clarity at SocGen about the constructive risks on the right side or the agony Talebian risks on the left side of the tail?
Yeah, I think it's fair. Rather than what we had, back in October last year, rather than we didn't have, those very extreme tails and that centered, dispersion of the option curve. Now, things have changed. Things have changed dramatically. And now what we have is, if anyone is looking for more balanced, more moderate volatility regime, and that's literally where we are at. And I would not say, or not carried away with thinking where the low vol, the low VIX, numbers are saying, as against when you start combining different elements on the option market, you find it's more moderate vol, rather than extreme low vol. So, and if I cut it, and cut the chase, and if anyone is looking for, upside, the right tail, one should still be looking for the US. US is the place to be, as against, when we watch Eurostoxx 50, it's a better place to watch for the left tail. So the differentiated nuances, things have changed though since October last year.
Decades ago, with Paul Wilmot's leadership at Imperial College, he put out a magazine on quantitative finance that was a Bible. We all read it cover to cover every 6-8 weeks whenever it came out. And one of the great, great hallmarks of what Paul Wilmot said is find out where the bet is. Where's the bet right now in the summer of 2023? Where's the extensive money being placed that sometimes can be wrong?
Yeah, at most of the money that we have seen, it's it's still into NASDAQ, it's still into different form of AI, it's still into technology. And that's literally where all the excitement has taken place throughout this year. And then if I look at where S&P is, I think when we split micro versus macro signals, it's very clear the micro signals are very positive. Whether it's AI-driven EPS, whether it's industrial profit margins at all-time high, and then one of the very differentiated points we have raised at SocGen is the current Fed cycle is actually helping the top 10% of S&P 500 companies, which is the top 10% of stock. They're cash rich. They're making interest income rather than interest and expense at this point. All of that, what it does, it's creating extra micro-based, micro signal-based earnings, earnings-driven signals where earnings volatility goes lower, and that drives a lot of the equity volatility as well. So we are quite positive on the micro front. We find out of the 3 points that I flagged, at least one of them, which is the U.S. fiscal, the U.S. industrial policy, the U.S. Inflation Reduction Act, as in literally all of those. As in, I would say U.S. has a 5-year industrial policy as of now.
Manish, you just recently raised your S&P 500 target to 4,300, which is still significantly below where we are right now, which means a bit of a downdraft by year end. I'm wondering from your vantage point whether you would see anything or what you could see to raise that target further.
And then our take is, and then we come up with quarterly outlooks and quarterly profiles, and then we think S&P goes to, 4750 before we see all the negative elements in terms of, as you mentioned, the labor cost, the union cost on corporate margins, the credit cost. As in we are seeing, we are expecting as in half of the Russell 2000, the small companies refinancing, will happen within 2 years. As in it started this year, it gets extended next year. So as in my hunch is, I think we are very bullish on the micro front, but we are not, bullish on the macro front, which I would say, that's literally the reason why in asset allocation, we are neutral stocks, we are neutral U.S. equities. And I think that's the right call to do, just when, there's a big fight between micro versus macro.
Right. Manish, got to leave it there. Manish Kabra, thank you so much with SocGen this morning here on the Dynamics. Get the teeter-totter, and he's sitting right in the middle with a balanced portfolio. Charlotte Hughes Morgan, Bloomberg reports for Bramo, for the benefit of Bramo. This is the heart of it. I'll read the headline verbatim because Bramo helped write the story. Amazon cracks down on employees who stay away from the office. Amazon expects U.S. workers 3 days a week. Firms from Zoom to BlackRock are demanding Bramo more on-site work.
This was an amazing story because they also evidently accidentally sent out reprimands to people saying, you know, you have not been to the office at least 3 days a week for the past number of weeks. And then they said, well, we have. And then they came back, whatever. It shows the tension right now. And Amazon
shirking
their
duty.
duties. Well, Amazon has been trying to bring people back to the office. There were picket lines for people who did not want to go back to the office. Amazon now coming out with a more strategic way of cracking down. You heard Google come out and say that they're going to evaluate workers based on their in-office attendance. There's a real push. Get back to the office, and workers are like, no way.
Do
Like,
you
we
think
have a lifestyle.
it's generational? Is it like Bitcoin where people of a certain ilk are like, no, and the younger kids say Bitcoin's legit? Is it generational?
You mean like
3
the
days a
Instagram
week?
generation that people basically wanted to travel?
No, the young-
I think that
yeah.
I think it's a lot more complicated than that because I think that you have people who want to learn and who are coming into professions. I don't necessarily think that. I do think that there is this feeling if you create a lifestyle that you think you can work from home, and then you've got to go
try it
back
next
to the
week.
office. Are you trying to send me home?
Well, no, she was at her Paris flat through the pandemic. Lisa was working
not,
at home,
no.
and you know, John and I are in New York slogging away, and she's in Paris with the trees and the boulevard out front and all that. Thank you for your attendance this week on radio and television. At 2 p.m., the stamp collector William Gross will make an appearance. Bill Gross on Mexican Carry. Stay with us. This is Bloomberg.